Hi, good morning, everyone.
Yes,
Good
Mr.
morning, sir.
Abhay, we can start now.
Okay, right. Morning, all. Um, uh, good. Welcome to everybody from the Bangalore Values Association. Like most of you know, who when you've attended, we try to organize programs which are requested by the valuers. So this particular program on valuation of complex instruments has been requested by valuers time and again, and we are very happy that the organizers, in this case, Shilpa, uh, have has taken the um, taken the trouble to find a very good speaker for us to speak on this topic. So that's one very important thing to keep in mind. At Bangalore Valuers Association, we are basically valuers ourselves. And the important thing for us in the association is to hear from fellow professionals about challenges that they face in valuation and try to use that in our own practice. And I think that to a large extent, the speakers whom we've been able to bring to speak about valuation challenges faced uh, have been quite good. So we have to thank everyone who's done this for us. So, for instance, Subbarao has organized a few speakers. Shilpa has organized many of them. Ravindranath has done a few. Uttam Padiwal has done brought in people. So almost every member has been bringing in valuable speakers to speak to us on the topics of valuation. And what we are trying to do is to make this affordable to everybody and to make sure that it's giving us the required continuing education hours. So courtesy ACVA, which is also run by valuers. ACVA is run by a couple of valuers who have got a very large valuation practice. So they've also helped us in making sure that we are able to give valuable CEPRs to our members. And it's at a very affordable price, which is, I think, a very great thing. So overall, thanks to everybody who has taken part in organizing this, especially Shilpa, Subbarao, Ravindranath, Chetan, and a few other members from the managing committee, like Mr. Srinivas, who has been helping with the website, Anjan, who has helped with the website. Then we also have Mayur, who does a lot of work related to the setting up of the programs. So thanks to everybody. And with a short introduction, let me hand over to Shilpa.
Uh, Good morning, everyone. It's my privilege to introduce today's speaker. Mr. Atul Gupta is a chartered accountant and MBA with more than 15 years of experience in transaction advisory or corporate finance. He is currently working with EY Valuation team as director and advises clients on business valuations, intangible valuation, and financial instrument valuation. He has performed more than 500 valuations, business, instruments, and intangible valuations. He has advised client on various transactions, mergers and demergers, PPA, internal restructuring, and various compliance related valuations include exchange control, taxation, and accounting. Besides the regular business and intangible valuation, he focuses on valuation under complex capital structures and has advised various unicorns on the same. Mr. Atul, we welcome you to for today's session. Over to you.
Thanks, Shilpa, and good morning to everyone. Pleasure to be here and discussing something on the convertibles and the valuations under the complex capital structure. Uh, I just wanted to be a very interactive session, so just feel free to buzz, feel free to interrupt me and discuss whatever you want to. I'll try to answer whatever I can right now, or else probably I'll get back to you later on. But better to have an interactive session rather than a monotonous and simply me speaking. It'll be kind of a bit bit new for most of you guys. Typically, this per se a product, or for that matter, the valuation process is evolving right now in India. And over a period of some years, actually, we'll see more and more valuations coming up this way actually in India as well. As such, actually, there is hardly any clear-cut guidelines right now in India. Even if you look at in US, yes, there are some guidelines around that. But one, they are litigative, and second, they are still discussed a lot in US as well. So, I mean, it's an evolving practice clearly in India. US, it's a bit settled comparative to India, but again, I mean, it's evolving and the guidelines are coming in around the same. when we actually come to the valuation of instruments or a valuation of the securities under the complex capital structure. So it's an interesting topic. We all are learning and happy to discuss it whenever you want to just raise a question. So I'm just taking the liberty of sharing the screen, and then probably once it is visible, so I'll just start actually discussing on that. Let me know when the screen is visible.
Yes,
Is
yes,
the screen visible?
yes. You can make it presentation mode or slideshow mode.
Sure. So I mean, thought basically whether or before we'll actually get into the complex valuation under the capital structure or complex capital structure, I thought actually simply just we'll actually spend a couple of minutes on a normal valuation methodology basically, which is primarily the business valuation. So whenever actually we are doing a valuation of the instruments, primarily actually it can be broadly bifurcated into two different phases. One, the business valuation or to arrive at the overall equity value of the company. And the second, to allocate that equity value of the company into different classes of shares. For arriving at the business value or the equity value of the company, I mean, typically, as we all know that typically there are three different approaches. One is the income approach, market approach, and the asset approach. When income approach typically look at the futuristic cash flows, and we kind of typically discount it back to arrive at the current present value of the company. Market approach, I mean, primarily there are two different approaches. One is the comparable quoted company by comparables, which typically we call it as a, or trying to compare and draw the valuation from, or basis the basis the companies out there in the market. So and then from a transaction multiple, I mean, we try to look at the companies where the transaction has happened in the similar space and try to apply the same multiple. Net asset approach, I mean, the cost approach, in case if we have to replicate that entire asset again, then what might be the value of that asset? So just moving on from here on. I mean, some of the key factors typically we as a valuer actually look at whether we have to apply while we applying a income approaches, whether we need to look at FCFE or FCFF. Certain certain set of specific businesses where actually we also go for FCFE, though FCFF is preferred. FCFE is say like the banking or the financial companies, wherein the leverage or the impact of leverage actually on the company is not known. And there actually typically we go for FCFE, otherwise normally actually we always prefer FCFF approach. The most important part is what discount rate we need to take, and then how to leverage that. Now, most common approach is to use the CAPM, I mean, for the WACC or the cost of equity. At the same time, actually, when we are doing a startup valuations, so or any company which is there in a growth phase or expansion mode right now, and then the projections can't be done actually with certainty. So there, besides the normal CAPM approach, some other studies are there actually which prescribes that what could be the discount rate for those kind of companies, and that is typically known as the venture capital studies. So those studies also can be considered for that, and for the WACC purpose. And the discount rate could be as high as 70-75% at times. That depends basically at what stage the business is in. For the terminal value, again, I mean, normally we apply a Gordon growth or a feeding growth or H model. But when actually we are, and then why I'm talking right now about the startups more, because we are going to discuss the startups in detail, and typically you look at the complex capital structure in the startup. So therefore, I'm just focusing a bit more on the startups. Also for a startup, actually, I mean, yes, a Gordon growth approach model can be applied for a terminal value. But given that they typically happens to be in a growth phase, and specifically the last year of explicit period, the growth rate is a lot higher. So either, I mean, one can apply a feeding growth model, or even can apply a exit multiple. And when I say exit multiple, means it's a blend of the DCF and the market approach. Market approach means you'll just actually draw the multiple and then apply that multiple in the last year of the explicit year, and then actually again discount it back to arrive at the present value. So it is a bit different from Gordon growth, but it's typically and very oftenly used for a lot of startups. Market approach, I mean, the normal multiple happens to be the EV revenue, EV EBITDA, and then the P multiple. Obviously, that depends basically at which segment actually of the industry are we applying the multiple, and what is the stage of the company. I mean, for a startup, typically it's a EV to revenue multiple is looked at. For the share region, that they are typically not profitable, and therefore the applicability of EBITDA or P multiple can't be explored in that. But yes, I mean, we can actually apply any of the multiples, but the preferable approach is in case if the company is actually generating a sustainable profitability, we should look at the EBITDA multiple or a P multiple. Again, the better approach is to look at the EBITDA multiple for the share region, that it actually kind of gives us the operating value, the valuation of the operating asset separately, and actually ignores the impact of the leverage on the company. So PE multiple typically is applied, say, for a finance company again, wherein you just actually cannot make out basically what is the difference between the leverage and how much debt is contributing to the overall growth of the company. Second issue which typically comes up is whether to apply a CCM or CTM. Typically, CTM normally have some sort of a control premium, and then therefore it's a bit higher as compared to the CCM normally. So either a CCM can be adjusted in case if the valuation is being done for a strategic purposes. Else, I mean, you can also look at the control premium through a CTM. While actually applying a CTM, typically and normally, I mean, we need to look at who is the investor, what is the purpose of the investor, whether it's a PE fund, a pure play financial investor, or a strategic investor. And in case if strategic investor is coming in, then what kind of a premium actually they are ready to pay for the target. So that is specifically which actually need to be evaluated while applying a CTM. So what is the purpose and why the investor was coming in, what kind of a synergy they are getting, and what kind of a rights they were trying to generate. So normally the strategic investor will have some sort of either a backward integration or a forward integration, or it could be even horizontal as well. But yes, I mean, there would typically happens to be some sort of a synergy benefit. PE investor, specifically under startup, actually comes with a lot of differential rights. Obviously, we are going to discuss those rights actually in the subsequent slide. But yes, I mean, those rights are specifically need to be evaluated in case if they actually have a beneficial right as compared to the normal right available with the equity shareholder, then the adjustment need to be done, and accordingly the valuation need to be calibrated from that.
Atulji, Sanjay here. Can I put a question? I didn't understand what CCM and CTM is. What is the full form of that?
Okay, sorry. So CCM is comparable company quoted multiple. A company which is there on the listed or which is there on the stock exchange. CTM is comparable transaction method. So you are trying to evaluate basically in case if the big transaction actually has happened within the company or the shares of a comparable company.
So it's of a market deal which has happened recently, and then that's how you.
That's absolutely correct. In case if a market deal has happened, so that we are referring to as a CTM, a transaction multiple, and CCM is a quoted multiple for a listed company.
So transaction method, you should be privy to that transaction, correct? How will you compare to absolutely unless you know each and every steps of the transaction? How do you do it in practice? What is the way?
So the way to look at it is basically, I mean, what sort of information is available in the public domain. Typically, there are a lot of databases actually which provide you a lot of transaction multiples, say a Thomson, a Capital IQ, a Capital Line. So there are a lot of databases actually through which actually you can actually look at the transaction. I mean, say VC Edge or Thomson Reuters. So you can actually look at the transactions. They'll give you decent details about the transaction.
And if it fits your particular situation, then you kind of say it is comparable, or you have to recalibrate it, or you just take it as it is.
So that depends basically what you are doing and for what purpose you are doing it. Yes, at times actually we need to recalibrate it. As I'm mentioning that, I mean, what is the purpose of the transaction? Why someone has put in, and then say what are the specific rights in case if there are any with the investor in the specific transaction, and there actually you need to recalibrate it.
Right.
So when we are looking at the transactions, you need to be very clear on that. A lot of transactions are currently happening with a future payment as well, or wherein there is a promise that yes, we'll actually pay in future as well, and all those things actually need to be captured in an appropriate manner and need to be adjusted while actually you are applying a multiple for a CT.
Okay.
Sir, this is Sheetal this side.
Yes.
Sir, what recent transaction means? How recent it could be? 6 months back or 1 year back?
Uh, so again, I mean, there is no specific guidance on that. At times, in case if you are looking at a mature industry, you can even look at a bit dated transaction. In case if you are looking for a clear-cut startup, you ideally should look at the recent transaction. I mean, preferably it should not be more than 6 months old, specifically for a startup, or say a specific event has happened, say like a pandemic happened. So preferably, actually, we should keep it at say 3 months to 6 months. But at times, in case if there is no availability of information and if no recent transaction are available, then we can actually go back to probably a year or 2 years and try to evaluate basically that in case if a transaction has happened 2 years, then how the valuation multiples could have moved actually over a period of time. It becomes a bit challenging, but I mean, preferably we should not look at anything prior to 1 year. But I mean, that depends basically on the availability of information.
Okay. So what is the, as per your experience, what is the probability of getting such kind of transactions for comparing it with startups or growing companies?
So obviously, I mean, one, there are no clear-cut identical companies in the globe.
Correct.
So you cannot actually find a same company. And then therefore it's always challenging basically what kind of a multiple you are looking at or transaction you are looking at, and we typically need to expand our horizon. So rather than to look at the identical companies, we first either try to look at the similar companies. Even if not the similar companies, then the similar business model. Even if not the similar business model, then what kind of a similar risk profile could be there in a different business model. So you just actually need to keep on exploring basically what can be applied, and that's all. It all depends on the discretion of the valuer. I mean, there is specific guidance around that again. Uh, in our world of valuation, actually, I mean, given that the guidances are not there, and it's also very difficult actually to specifically lay down the rules. So a lot of things depends on the discretion of valuer and the expertise of valuer. The key issue is that if you have actually shortlisted a single transaction or a two or three transactions, you need to consider basically why the transaction is comparable to the valuation subject. It could be the business model, it could be the uncertainty, it could be the expansion, what stage of the growth the company is in, whether they are at the ideation stage, or whether they are at the pilot, or whether they are generating the revenues. So all those things need to be captured. So I mean, whether it's a tech company, whether it's a platform, what are they doing, how they are doing it. So all those things need to be considered. And typically, yes, you will find a transaction, not the identical, but try to look at the transactions in the similar space to the
So,
extent possible.
okay. So, sir, when you mentioned that in CTM, you have to see synergy benefits versus special rights like
Sheetal,
equity.
sorry to interrupt you. The present session is on valuation of complex instruments. All this is all market approach, just an introduction slide. And this is a very complex subject going on. A lot of complex instruments are coming in. So I request to be specific to this topic, not this present slide, because this is just an introduction slide.
I knew it was coming from you.
Yeah, so I request Mr. Atul to go
Okay,
ahead considering
okay.
the time constraint. It's a very difficult topic, Sheetal, and this is mostly on market approach. That's why this request.
Sure, no issues, Shilpa.
So Shilpa, just to answer, I mean, strategic in case if you can evaluate that there are going to be some benefit and they would have paid some premium to that, it can be adjusted. Otherwise, actually, you can have a subjective premium, which you believe could have been. So you actually need to compare it with the financial transaction and the strategic. Try to look at what could be the premium for the strategic investor, and then remove it for the calibration of the valuation of subject company. Sorry, just moving on. Again, I mean, typically the asset approach is not applied for the startups. I mean, given that they don't capture the expansion and the intangibles, it can be applied typically for a capital intensive valuations. So moving on to the critical part and what this entire presentation is all about. So of late, we have been witnessing a lot of startups actually raising the funds through a blend or through a variety of instruments. It could be the optionally convertible instrument, it could be the compulsory convertible, it could be the debentures, it could be the shares. So anything actually which is other than the equity shares, a lot of companies are actually raising the funds through that. And whatever funds they all are raising, they specifically provide very different rights to all the shareholders or specifically the investors. So some of the instruments actually, I mean, it could be the preference share, debenture, optionally convertible, compulsory convertible, redeemable. So rather than to look at basically what is the nomenclature and what is the word, say preference share, debenture, or whatever it could be. So don't go by the word. What as a valuer we need to understand that what is the commercial intent of the investor and the issuer, and that is the most important part. Why they have issued that instrument and how the return or the economic benefits will be reaped by the investor. So what are the key conversion terms? What are the key redemption terms? What is the commercial intent? Why the investor has come in? What is the tenure? For how long the investor will continue with the company? Those are the most important part. Ignore the nomenclature of it being a share or a debenture. Typically, as a chartered accountant, yes, I mean, we always look at that share means it will be classified as an equity, debenture means it's a debt and will be classified as a borrowing. But from a valuation perspective, we just need to ignore that entire accounting parlance or accounting guidances. Simply look at what are the key terms of the instrument, and that is the most important part. So understand that each and every single term from a commercial intent perspective. There could be scenarios wherein a compulsory convertible share can be classified as a debt. There could be scenarios, I'm saying, repeating, compulsory convertible shares. So share which is compulsory convertible into equity is classified as a debt. And there could be scenarios where we are saying it could be redeemable and can be classified as equity. So that all depends basically on the terms of the instrument. And therefore terms become important, the rights becomes important, nomenclature has nothing to do with the valuation per se. Normally what happens, in case if, so typically in case, so I've mentioned that there is a fixed to fixed criteria. Fixed to fixed criteria means in case if the conversion is fixed, that yes, one debenture or a one equity share or a one preference share will get a one equity share. There actually it could be classified as a equity instrument. Again, I mean, obviously depending on the other terms as well. Wherever there is a variable payout in future and there is no fixation in terms of the conversion ratio, then normally it is categorized as an equity. So in case if the conversion ratio is fixed, it can be again, I'm saying can be recognized as an equity or classified as an equity. And when I say classified means it can be valued as an equity also. In case if the ratio is not fixed, typically normally wherever there is a variable payout, normally it's being classified as a debt or the valuation is also as per the debt. So it is just an example. Basically, I mean, traditionally and earlier we were looking at and how the companies raise funds. I mean, say RBL actually raise funds. Don't go by the numbers. It is just for a discussion purposes. So RBL actually raised funds somewhere in 2011 at a specific valuation in 2012. But at all the times, actually, they were issuing the equity shares. So typically, a Lenskart actually raised funds in 2011. say through, so the specific word out here is they actually raise fund through Series A CPS, Series B CPS, Series C CPS, Series F CPS. So ultimately, yes, I mean, we are talking about they're also raising the funds, but the key issue out here is that every time you look at the Series A, B, C, F, G, D, E, whatever it is. So they are trying to create a different class of share, Series A, B, C, D, E, F, G, whatever it is. Whereas earlier, traditionally, we were looking at the equity shares only. And that is where the entire differentiation comes in. What class of shares we are issuing vis-a-vis what class of shares earlier traditional companies were issuing. In case if we are issuing a different class of shares, then the valuation will differ. And that's the key or the most critical part right now. There could be scenarios that currently, though we are talking about CPS, there could be say equity share also, and equity share with a different rights. So again, as I earlier mentioned, that don't go by nomenclature. It could be equity share, it could be preference share, it could be debentures, it could be anything. Simply look at the terms, and if the term differ, the value differs. So normally, I mean, if you look at the traditionally, I mean, the preference shares what were issued, they typically had a specific or a decent dividend which were typically benchmarked with the market rates. It could be 8 to 12%. It could be higher than that as well, depending on the risk profile of the company. Normally, typically are redeemable, but yes, at times also they are convertible, but normally they were redeemables. Uh, so why the company do not actually prefer to issue the preference share per se or the word share attached to it? Uh, from a taxation angle, actually there is there is no benefit of the interest component to that, and it actually tend to have a double taxation impact, and then therefore they actually typically the issuer from a legal perspective look at the debenture word, but the valuation happens to be same, at least from an investor perspective, and under both the scenarios. So what happens? I mean, if you look at the present day, for the startups, uh, they kind of tend to issue the convertible preference share. These preference shares typically do not have any dividend per se, and then they just need to have a small dividend or negligible dividend only just to meet the regulatory requirement. So typically they have a 0.1 or 0.001 or whatever it could be, which typically happens to be immaterial. The second key issue out here is that the early investors, I mean, whenever we are talking about VC or PE fund, they do not want to get redeemed. They actually want to enjoy the upside of the equity. And then therefore, though we are talking about preference share, so therefore, typically, normally the redemption or the intent of redemption is not there in that, and that is why actually it is being normally valued as a share and not the debt. Even if say we are talking about a convertible debenture or a convertible debt, then also the commercial intent is not to actually redeem, continue with the company for long, and once the company get listed or once company actually achieve a specific level, after that reap the benefits of the growth and then move on. Some of the very key important rights are, again, I mean, the rights broadly can be classified under two. One is the control right and second is the economic rights. Both have a specific value to it. So control rights are basically where we are controlling the company or the other shareholders. For example, we have, irrespective of what kind of a percentage of shareholding we'll have, the investors are entitled for a board seat. They are entitled for a lot of insider information, say like MIS and other things. They can actually enforce the other shareholders to, which are typically called a drag along right, to come along with them in case if they are looking to sell the shares. And similarly, in case if others, any other shareholder is selling it at a beneficial rate, which they feel is beneficial, they can actually tag along with that as well. So there are specific rights which typically are referred to as control rights. Quantitatively, the value of these rights cannot be ascertained, but yes, there is a value to it. So typically in transaction multiples, which earlier we were discussing, you will find some value to it. Technically, from a quantitative perspective, the valuation cannot be ascertained. Then there are other rights which are typically the economic rights. That is, what additional benefit, financial benefit the investor are going to get. And when I say additional benefit means the preference shareholders vis-a-vis equity shareholders. So what benefit or additional benefit the financial benefit the preference shareholders will get over and above the equity shareholder, there could be a specific right around that. And that actually clearly creates a lot of value for the preference shareholders. So one of a very important right out here is the liquidation preference. What is liquidation preference? Liquidation preference means I have the first right on the assets of the company to a specific limit. And after that, only the equity shareholder or the other shareholders can pitch in. In case if the value goes beyond a specific level, then treat me as equity, and I'll also have an upside of equity shareholder as well. I'll discuss this in more detail actually in the subsequent slide. Another key important right is the down round protection. So what does that mean? In case if there is a transaction in a company at a valuation which is lower than my valuation. So say suppose in case if Series A or Series B put in money at a specific valuation, say 100 rupees per share, and if someone is coming at say 80 rupees per share, so I have a right to change the conversion ratio. I'll not be converting at 1:1. I might be converting at 1.25 in case if it happens to be at 80. So one share for a 1.25 equity share, or it could be different depending on the terms and conditions of the contract. I mean, there are some specific rights which have a lot of value around that.
So Atul, one small question.
Yeah.
When you are valuing, will you give a different value to say full ratchet anti-dilution rights as compared to, let's say, broad-based or weighted average? So you assign different values to each of these rights, or it's just added on to the overall valuation? If you're covering this part later, please proceed also.
So probably, I mean, I'll not be covering the downward protection or anti-dilution right per se, but broadly I'll answer your question. Yes, the value happens to be different for each shareholder. If you look at from a issuer perspective, when I say issuer means the company perspective, typically there is not much of the value in the down round protection. I mean, given that initially I told, so the business value is being allocated among all the shareholders. So the loss or profit happens to be a kind of a contrary to each shareholder. So the later series, say Series G in Lenskart, will be benefited, and the loss will be to Series A, Series B, or the equity shareholders. So there is, as such, from issuer perspective, there will not be any impact on the on the balance sheet of the issuer for a down round. There will be a benefit to the Series G. Yes, when you say the full ratchet or a partial ratchet or a weighted average, basis the terms only that valuation or that value need to be arrived at, and that need to be considered while actually valuing those rights.
Thank you.
Here, should we consider pre-money valuation or post-money valuation for this allocation? Because that when that round happens, no, you'll get money into the company. So what should we consider? And when you are valuing for that particular round.
So when actually you are doing the valuation, ideally you should look at the post-money valuation and also consider the new issuance within the subject target valuation subject, or for that matter the comparable company, whatever you are looking at, given that those shares have been issued to the company and that position is there right now on the balance sheet of the company. So the ideal scenario is look at the post-money valuation. In case if you are doing it for the issuance of the capital, you can actually look at pre-money. In case if you want to issue an instrument which is different from the existing instruments, then you need to evaluate the post-money valuation also. So I mean, it's basically what target and why you are doing the valuation. For issuance purpose, look at the pre-money. In case if the rights are different for the instrument which is yet to be issued, for which the valuation is carried out, then you need to do the post-money. Otherwise, preferably a pre-money. Comparable company, in case if the transaction has happened, always look at the post-money valuation. Yeah, moving on. So typically, why do they actually put the money in a startup? I mean, the purposes are totally different. I mean, they typically are very volatile. The success ratio happens to be a bit lower and all those things. It's more a theoretical, and I'm just moving on from this right now. So I'm taking an example right now. I mean, in case if you just want to jot it on a piece of paper, you can. And then this is the example actually which we are going to discuss in the subsequent slide. I mean, how the valuation is arrived using this method. So it's basically a lala.com or whatever xyz.com, a primary startup with a seed capital of about 1 million. Later on, Series A investors came in at a valuation of 50 million, and wherein they invested 10 million of money. So some of the key points which I'm talking about, the initial investment was 1 million. That you can refer to as the equity, plain vanilla equity shares issued for 1 million. The total investment amount is 1 million. Series A, investing 10 million at a valuation of 50 million. Series B later on actually happened at a and they invested 50 million at a valuation of 200 million. Series C happens to be at at a valuation of 500 million, wherein they invested 100 million. So the key component out here is what amount they invested and at what valuation they've invested. And there are 4 different classes of share. Common shares, which is the plain vanilla equity, 1 million invested by the promoters who started the company. Series A, Series B, and Series C. So we are talking about 4 different classes of share. The key right actually which we are talking about, which we earlier discussed, the liquidation preference. Series A, Series B, and Series C have a liquidation preference equivalent to the amount which they invested. So Series A have a liquidation preference of 10 million, the amount which they invested. Series B have a liquidation preference of 100 million. Sorry, Series C has 100 million and Series B have a 50 million liquidation preference. The rights are again, Series C is senior to all the other series, given that they actually put in money at the last or the latest entrant in the company. Series B is senior to Series A and equity shareholder. Series A is senior to equity shareholder. So that means the first right on the capital of the company is Series C, followed by Series B, Series A, and the equity shareholders. Hope this is clear. I mean, then I'll just move on to the other slide. Probably one of the most critical part.
Yes, you can go ahead.
So this happens to be the share capital structure of the company. I mean, in terms of, ignore the date of investment. This is the amount investment, so-called valuation at the time of investment, a number of shares, and what is the per share value in this case. I mean, you just actually either take a print screen snapshot or something, because this is something which we are going to discussing in future in detail. I mean, subsequent slides. So this is a pretty important slide from an input perspective.
Hi, this is Harshil here. Is it possible to share this presentation later on?
Yeah, I'll share the presentation. No, I'll share the presentation.
The point of noting by the speaker was to understand the next slides better.
Understood. I know that, but just for future reference, we wanted that. That's the request.
Yes.
Sure. So earlier, I mean, we were talking about the payoff or the liquidation preference. So what happens? I mean, in case now this is a graph basically how the liquidation preference works. There are 3 or 4 different levels within this graph. You look at, say, from 0 to 100. I mean, which is there on the horizontal line. Whenever the valuation of the company is between 0 to 100, entire amount will go to Series C shareholders, and that is the liquidation. That is the right which is being created by the liquidation preference. That initial 100 till initial 100, I have the entire right on the shares. From 100 to 500, I mean, so we initially said that they came in at a valuation of 500 million. So because they have received their 100, the pie or whatever the investment amount of 100 right now, so till the amount from 100 to 500, they'll not get anything, and the amount which they'll get is only 100 million. And therefore, the return from them for series shareholder is same from 100 to 500. And after 500, what will happen? They'll convert into normal equity, and then they'll enjoy the benefit the way equity shareholders are enjoying. So the valuation will keep on moving up for that purpose for them.
Sorry, sir. Can you please go back one slide?
Yeah. So if you look at that, yeah, sorry.
Just stay here for some time, please. Screenshot is
Sure.
not possible with Zoom, it seems so, because somehow it is not giving that option of taking a screenshot.
Sheetal, can you just take a picture on your phone?
So if
One more question I have. A number of shares.
Carry on, Rakesh.
sorry,
Yeah. How you got the number of shares? Because they have invested 50 millions. According to that, you are doing, or how you are doing?
it is primarily according to the investment amount.
On the investment amount. So you are taking a
On the
number of
investment
share,
amount.
number of share for the series 1 or series B, like this way, not the total shares.
Yeah, that's correct. I mean, that's correct. I mean, it's primarily for a discussion purpose. It's an example per se.
Okay.
And therefore we have done it on that. Obviously, I mean, in whenever you are doing it practically, the number of shares and all those information will be available to you.
Yeah.
Atul, in this sheet, if you can explain the liquidation preference for series ABC, that will be more clear for me, if you don't mind.
Sorry, I didn't got the question. Can you repeat that?
The liquidation preference for series C, series B, and series A in this table, if you can just give a gist. What you have said in the next slide.
So the investment amount which you are looking at for series A, B, C, that is the liquidation preference for them. Investment amount 10, 50, and 100, that is the liquidation preference available to them.
Okay. Yeah.
I am trying to explain in the subsequent slide how that works, and probably they're trying to clarify the concept of the liquidation preference.
Okay.
So
One
Atul,
more
just looking
question.
at,
One
sorry,
more,
Rakesh.
one more question, sir. For series C, as you told, the valuation will be 100, then the preference will be given to series C. Okay. Suppose the valuation not 500, it comes to 200 or 150. Then only C or B will get a preference.
So that is something which I'll be capturing in the subsequent slides.
Okay. Thank you.
Okay, I had the same question, so carry on.
Sure. So I mean, the investment amount is a liquidation preference. We are saying series A is the senior most, followed by series B and series A. So these are the concepts which you need to just keep, and then probably I'll move that. So what will happen in this case, if you are looking at the graph right now, series C has a liquidation preference of 100. That means series C will have a initial right till the time the valuation of the company is 100. Entire amount will go to series C. Nothing will go to any other shareholder. Once the valuation of the company goes beyond 100, then only the other shareholders can come in. So say suppose currently though we are talking about the valuation or the came in at a valuation of 500, God forbids, but unfortunately the valuation tanked and the valuation happens to be 50, 70, 80 million. Then series A, B or equity shareholder will not get any amount. The entire amount will go to series C. Whenever the valuation moves beyond 100, then only series B, A and equity share will start actually coming in.
So Atulji, Sanjay here. One question: when you say the valuation is at $80 million, correct in this case, and then so the presumption is the new investor will come and buy the shares. So then in that case, what happens? I mean, will he be sold the shares of only Series C? And what happens to A, B, and the original equity shareholders? I mean, how does it practically happen in terms of transfer of shares, if I may put it?
So suppose actually when I'm talking about 80 million, the entire 100% I'm talking about the 80 million. I'm not talking about Series C only. entire shares, equity shareholders, Series A, Series B, and Series C, everyone had to sell the shares. So as I told you that there is a control right, which it's typically called a drag along right. Now Series C will enforce other shareholder to move along with them and then sell the shares. So those rights are available actually in the shareholders agreement normally.
So in that situation, let's say the equity shareholders, the original and A and B will not get anything. They will be transferring it at nil cost. And
that's correct. Either they'll be transferring at a nil cost or probably an agreement. Yeah.
And will they
Atul sir, the liquidation preference will kick in only in the case of liquidation of the company and not during the transfer of shares. So, so is it not that, I mean, because of the other covenants in the share holding agreement, which can be drag along or tag along, it is not true that Series A and B will not get anything. They will get whatever is the value of the company, but liquidation preference will kick in only at the time of liquidation of the company, not any time before that. Am I right?
Okay. So when we are using the term liquidation preference out here, normally the shareholders, the shareholder agreement actually prescribe a liquidation event, and that includes the merger, a major stake sale in the company, or for that matter, even when a division is being sold off of a company, a major division is being sold off. So it's basically defined in the agreement.
The session is going interesting like a movie now.
I mean, I still have one question. Sorry for the interjection. So when these guys transfer the shares at a lower value, correct? So which means that they can be subjected to capital loss because let's say Series A would have invested at a particular value and now they're getting nothing. So is there a tax planning opportunity here for them?
Probably I will not call it a tax planning per se, because I mean we are losing the money out here and we don't want to plan actually where we are losing the money. So it's not a tax planning, but yes, I mean they are losing on that investment amount, and yes, I mean there could be a set of that loss against any of the other income which they might generate.
I mean, if it is an unlisted company, a company in which public are not substantially interested, then probably the capital gains option, savings option might not work out because the transaction value will be replaced by the fair market value, and the method of computing the fair market value would be different in that case than this.
So normally what happens actually for a startup, typically when you talk about the fair market value, and probably when you are drawing the analogy for a 50 CA or a 5627 or 10, I mean, so normally typically the startup do not have anything in their balance sheet, and it happens to be a negative or a negligible value in that also. And second, I mean, those sections specifically actually prescribes a fair market value for anything which is other than the equity shares. And preference share actually is classified as other than equity shares, and the fair market value happens to be nil in that case as well. So it's basically the cost of acquisition minus this. So yes, the benefit of tax set-off can be considered, but I mean I'm not a tax expert, but yes, I mean that's my view, personal view. It can be or it should be considered. But yes, I mean I'll not probably call it a tax planning, because ultimately we are losing money. And we want to plan that we are getting money and we are not paying taxes. So I mean the planning is a different word or connotation altogether.
Right. I mean, I didn't mean planning. Maybe if person is handling a portfolio of investments, correct?
And yeah, that's correct. Yeah, that's correct. That's correct.
Taxes in one group, and here is a situation where you can encash and then kind of set it off. That's what I meant by planning.
Yeah, that's correct. And typically that is how all the PE funds and then the VC fund actually comes in. Correct. So the idea is basically, I mean, the slide actually which I kind of moved on. It actually captures that, yes, I mean, typically only 5 to 10% of the companies actually give me a windfall gain. Otherwise, either it's at the investment amount or there could be losses of that. So in case if that is clear, I'll just move on to how the Series B will work. So Series B, the liquidation preference was 50 million. Initial 100 million, as we mentioned, that our entire amount will go to Series C. They'll not get anything. Valuation between 100 to 150, they'll start getting the amount. They'll continue to have the same value till the time at price at which they have actually invested in. So suppose they have actually put in money at a valuation of what 300 million. So they'll actually continue to get the same amount which they invested till 300 million, and after that the benefit will of moving into the equity will they'll start getting that gain in that. So it's more like similar to Series C only. The only thing is that if you look at it, the points have moved from 0 to 100, they are getting nothing. 100 to 150, they are getting whatever they'll get. 150 to 300, they'll get again nothing. The value will remain same, and after 300, they'll start getting the upside as an equity shareholder. So
this
these are
inflection
the
point.
Atul, yeah,
this inflection point is basically because there is 200 million was the value at which they invested plus 100 million of Series C. That's why you're coming to 300 million.
Yeah, that's correct. Yes.
Okay.
Similarly for Series A, I mean, initially 150, they'll not get anything. From 150 to 160, whatever, I mean, 10 million they have invested, they'll get it. And after that, I mean, whatever they've invested in, so say from 160 to 200, I think it 210, I mean, probably the inflection point might be wrong in the graph. So after that, actually, they'll just convert into equity and they'll start getting the money. And similarly, moving on, again, the equity payoff, once all the shareholder Series A, Series B, and Series C, whatever amount they've invested to the tune of 160, once they'll get 160, then only equity shareholders will start getting the money. And then there is a limited upside for them.
So can you tell me that Series B 300 I have not understood properly. See 150, 160 I understood, and then more than that I understood. But what about the 300 which you are told about for Series B?
I'll come to that in subsequent slide.
Okay.
I mean that is going to be the key parameter, so I'll come to that.
So Atulji, as we raise more funds, the boundary kind of shifts further and down. Correct. That's what we are saying in this slide.
Oh yeah, that's correct. Yes. Okay. I mean, as the valuation keeps on growing up, the boundary moves. The boundary moves only because the liquidation preference happens to be greater or bigger. So in case if you are not giving any liquidation preference right, the boundary will not move.
And for the equity shareholders, original equity shareholders, it becomes more distant as far as when they realize that. So unless
that's correct. But at the same time, I mean, though we are talking from a theoretical perspective, but practically, if you look at it, the valuation of companies increasing at the same time. And when the valuation of companies increasing, they actually tend to get the value. So what currently we are talking about from here also, if you look at from this chart, they are getting something from 160 million to 500 million. They are getting good chunk of money. Whereas if you look at Series C, they were getting everything till the 100 million, and after that from 100 to 500, they were not getting anything.
Not getting anything. Here they are starting getting from 160 to
from 160 to 500. They are getting something. They are making the money in that phase also.
So it's a double-edged sword. I mean, if you look at it, it's two-sided for each one of them. Yeah.
It is primarily, yeah, that's correct. But I mean, the key point is you are trying to create a liquidation preference. So in case if the value go down, then at least I'm able to protect my amount. And then that is the most important part. And then you never know basically what could happen actually in a startup.
Right.
Atulji, hi, this is Arcelia. Can you go to Series B payoff slide, please?
Yeah. Even I have a doubt here.
So you have mentioned here that 300 million inflection point, and
I'll come to that, Harshal. I'll come to that. I'll explain how calculated. I'll come to that.
Okay.
So I mean, it might be sounding a lot theoretical to everyone right now, but now I'm coming to a practical example that has happened in actual, wherein the liquidation preference kicked in and the shareholder did not got even a single rupee or a very low amount, and the preference shareholders make all the money.
And do we need to give a impact of options which was being granted to the employees or ESOP pools when we do this valuation?
Yes, we should actually look at the fully diluted share capital obviously that will make the things complicated. So I've not considered it right now here, but that need to be considered in that.
Okay, and this is a backsolve method, right?
So it could be done. I won't say a backsolve per se. I mean, I'll come to the differentiation between what this method is and what could be the backsolve.
Okay.
I'll come to that. But I'm just currently discussing right now the rights and what kind of a preference these rights are going to make. So till now, actually, we have just discussed the rights.
Okay.
I'll come to basically what method need to be evaluated.
And when we do
this, as I told,
sorry.
Yeah, sorry, Harsh.
So when do we do this valuation? So we need to have post-money valuation in our hand, right? As a starting point. Without that, we can't do a valuation of Series B. Say, for example, there is a company which has raised a fund, Series B CCPS, and for the purpose of accounting, it is being measured at FVTPL, fair value to profit and loss. So we need to have a post-money valuation as on the date of valuation for the purpose of doing this working, correct?
I'll come to that, not necessary. So I'll explain it to you in subsequent slides.
Okay. Thank you.
So now what I was talking about, it might be a very theoretical to most of us. But here is an example. It happened in US market. We are in good technology, which was founded in 2009, and that is there in the public domain also. You can look at it in public domain. They actually raised the money at 300 million valuation, and after that they got they actually filed for an IPO, which was cancelled. And ultimately they got sold at 425 million. And when they actually got sold at 425 million, the ESOP holders, as a part of compensation, understood that yes, they are losing money on that, and they were not even able to recover basically what they had paid. That's a practical example. They are in public domain. It happens for other companies as well in India domain. Unfortunately, in Indian market, I mean, they are not there in the public domain, but that has happened in the Indian market as well.
Can we say Snapdeal is a classical example of this?
I probably will not put it that way, because Snapdeal never got acquired by Flipkart or anyone else. Okay. But yes, I mean, if you're talking about Snapdeal, the time when SoftBank invested in that, it was roughly at a valuation of about 6.5 billion. I can't recall. I mean, that happened probably sometime in 2015-16. And Flipkart offer was around about, I think, 700 or 800 million. So yes, in case if that would have happened, then the ESOP holders or the early series shareholders would have lost, along with the promoter. I mean, say the Kunal Bhel and all those things would have lost it. And then that was again one of the reasons actually why they never went for this merger purpose with the Flipkart, because the valuation, or they looked at it pretty low, despite the pressure from the shareholders and the SoftBank.
So the person who has paid the more price and entered last will enjoy the liquidation preference first.
Yeah, that's correct. I mean, it all depends basically on the rights. Not necessary that the person who had paid the who came in at the latest level actually will get the first preference of liquidation preference. It could be pro rata, it could be first, it could be other. So that depends on the rights. I mean, obviously,
but
how they have negotiated.
Correct. So in case of pro rata says, how this valuation needs to be done? So there is a Series C CCPS. Series C CCPS is having a pro rata says. Then Series B will have a priority over Series A. Then how needs to be considered in valuation?
So all those inflection points which we are looking at, if you will come to say the slide, say Series C, now we were saying that 100 million is going to, I mean, from 0 to 100, everything will go to Series C.
Yeah.
In case if we are saying pro rata, suppose we are talking about pro rata, then we'll say 100 to 150. That 100 will go off, 0 to 150 will be shared between Series C and Series B. Suppose in case if it happens to be pro rata. So that inflection point will move on, one, and two, whatever amount you are actually allocating, that will also change. It will go to both Series B and C, depending on their rights. I mean, how they want to actually share in that.
Sir, maybe theoretical way,
shareholding.
Atul sir, like theoretical way, we are saying, okay, like in liquidation, Series C will get first Series B. But if you see in practical scenario, okay, we will treat, okay, even in under company SAT and IBC, we will
Sorry,
treat
your
all our
voice.
same series only.
Sorry, your voice is not clear. I mean, I'm not able to understand.
Maybe practical way, we are seeing that Series A, Series B, Series C will get, okay, in preference. But if you see in under company SAT and IBC, everybody will get the same price, same amount, whatever distribution, if company goes into liquidation.
Term sheet, sorry,
No, but
shareholders
here we are talking
agreement.
about the growth companies, but there those are the distressed companies. The valuation there is altogether different compared to this one. These are growing companies and those are distressed companies.
Sir, whether distressed company or growing company, liquidation company.
Liquidation process will be
No,
the same.
no, but valuation would be different.
Subarav, you got muted, I think, by mistake.
Yeah. See, whether it is going concern or whether it is liquidating company, that we have to follow the liquidation rules only. Then everybody will get the same. Okay, maybe for valuation purpose we are thinking, and practically where if company goes to liquidation, it will be different.
So will not the shareholders agreement take prior precedence? I mean here, because that will be enforceable, correct?
Yeah, I agree with Mr. Sanjay.
Atul, are you having a difficulty in presenting?
Oh.
Atul has got mute, I think. Yeah.
Shilpa, will you unmute Atul and see whether there's any problem?
Now he.
Oh, sorry. Is the screen visible to you?
Not yet.
Just give me a second. Some technical glitch from my end. Sorry.
Yeah. So while you do that, Atul, let me then just mention that. See, typically what I'm seeing in some of the shareholder agreements is that, like Atul says, a lot depends upon the negotiation between Series A, Series B, and Series C. So sometimes what I've seen is that the Series A shareholder comes in and says that he wants the same liquidation rights as Series C pro rata, which is, according to me, unfair to the Series C. But that's how they negotiate it. So they get the same rights. So you can't really. So what Atul says is absolutely right. It depends upon how they negotiate the agreement finally. Right, Atul? That's what you're basically saying.
Yeah, that's correct. Yes. I mean, it all depends on the rights and then how they have negotiated.
Yeah. Atul sir, I have a question here.
Yeah.
We do this, once we arrive at the equity value, enterprise value, and subsequently the equity value, the distribution of this equity value amongst A, B, and C, we do this inflection point and we do this comparable analysis. Am I right?
Yeah, that's correct. Yes.
Okay. Now, when we are arriving at the equity value, we take the important assumption of going concern. If you don't take the assumption of going concern, then the valuation would be quite different. The equity value would be quite different. But normally, we take the assumption of equity value. Once we take the going concern assumption, once we take the going concern assumption and arrive at the equity value, distributing that equity value amongst the various components of the equity on the assumption that there will be liquidation. Of course, liquidation is an event which will be defined in the shareholding agreement, which is not given credence to while arriving at the equity value. But for this distributing amongst the equity value amongst the various A, B, and C, how prudent would it be?
So there are two ways to look at it right now. I mean, one, what is the purpose of valuation? So always, whenever you are doing a valuation, the key and the foremost is what is the purpose of valuation and what will happen and how this valuation will be used. In case if we are doing a valuation, say for example, I mean, so when we were discussing our example of a Snapdeal. Now Snapdeal, what happened that earlier the SoftBank actually invested in Snapdeal at a valuation of a post-money valuation of so-called at 6.2, 6.3 billion. And after that, Flipkart offered them at a whatever, or 800, 900 million, whatever they were offered. Now, in case if we are looking at a transaction between a Snapdeal and the Flipkart at whatever 800, 900 million, at that point in time, you did not look at whatever inflection point which we are discussing right now. We know that the transaction is imminent, transaction will happen, 800 million will come in, we'll simply look at the liquidation preference and pay it according to them. So ultimately, say SoftBank had a liquidation preference in excess of 1 billion there. So we'll simply say and pay a 1 billion to Snapdeal. Sorry, I mean SoftBank, the entire amount will go to SoftBank and the entire valuation goes off. Simple as that. In case if we are evaluating it, say a step earlier when the SoftBank actually invested in Snapdeal, at that point in time, in case if the SoftBank invested at a valuation of 6.2 billion, which I am repeating, now is the valuation of the company 6.2 or something else? That actually you need to evaluate. 6.2 is primarily coming on account of the fact that the number of shares SoftBank got multiplied by the value they put in, and that value multiplied by the overall number of shares. So what we are saying that series A, B, C, equity, everybody has the same value. And that is how the 6.2 is arrived at. Whereas because the rights are different, so the valuation of company is not 6.2. So it's basically purpose, why, when, what valuation you are doing, it all depends on that.
From a compliance perspective, from a not from a management advisory perspective, but from a compliance perspective, is this differential valuation of components of equity acceptable by the authorities, be it FEMA, be it under Companies Act, or be it under income tax? Would it be acceptable, sir?
So it's difficult right now. I mean, as I told you that it's evolving in India. There are no clear-cut guidelines. I mean, the method which we are going to discuss, that's not there in or prescribed by any of the Indian regulators per se. FEMA specifies that a value arrived at using a internationally accepted method. So internationally accepted method, it can be used for that perspective. Even when we talk about the allocation perspective, so allocation can be done because the rights are there with the shareholders. So yes, I mean it's difficult, but for regulator to make them understand, but that is what it is right now. I mean, you cannot deny that the differential right will create a different value to it. Otherwise, equity shareholder will also say that, I mean, why a different right to you and why a liquidation preference to you? So if there is a specific economic right, there is a value tied to it. And then that is something which we need, as a valuer, we need to go and educate the regulators as well.
So if that is the case,
Mr. Atul, I have got a point here. In case of IBC, when the company in real sense is in liquidation, then whatever is the valuation or whatever is the realization, it is only the secured creditor. If at all the banks have lended something, and this P and all others have also lended something, it is only the banks which gets paid first if they are the secured creditors. These P's and these shareholder agreements, these all become irrelevant in that case. The distribution is never as per these agreements under IBC. It is always as per secured and unsecured. And these P's are mostly unsecured kind of things because it's through shareholders agreement, they reserve their preference. But in terms of secured, it is only the banks, if at all they have lended something to the company, and they get paid first. And all these becomes irrelevant. This is what is my understanding. If you differ with this, please explain.
In fact, I suggest that, let the speaker continue with his presentation. IBC is definitely a specialized thing. This we will take in the last, because there are so many important things with respect to, liquidation is
because
not just liquidation.
Because he said that we have to educate the regulators. That is why I pitched in on this point.
Okay, so again, I mean, probably I'll take this question. I'm just taking and going back to the basic concept. I'm ignoring this entire liquidation preference, everything right now. Keep everything aside. To start with the valuation, first of all, we need to arrive at the equity value. Whether it's under IBC, whether it's under transaction, whatever mode we are talking about. First of all, we need to arrive at the equity value. The equity value of a company is nothing but the enterprise value less the borrowing. When I say borrowing means the third party borrowings or anything or any liability which need not be paid or which is not coming from the combination of equity shareholder or preference shareholder or debenture holders. Once you arrive at that equity value, so automatically you are saying that I have paid off my borrowing to the bankers, to any other party, and then the allocation of that is being done using a specific method. So we are talking about the allocation of the equity value, nothing prior to that. So IBC, which you mentioned, bank are there. Yes, banks will take it. Whatever the equity value is left, this is that it will actually get allocated among all the class of shares. Hope that answers your question.
So practically under IBC, it is only the debt part which does not get served. Equity comes at last. So practically speaking, equity gets nothing in those kind of cases. Even the debt are not being paid. And those are, even the debts are taking the haircuts of 80% and 90%. Leave aside equity. Very limited point. That's it. We can move forward now.
So again, I mean, under IBC, it all depends. Typically, the promoter will get some sort of a equity, and the whosoever is coming in as an acquiring partner, they typically get the maximum equity. So whatever equity the promoter or the shareholders will left with, that actually will again get reclassified under this. So there is a typically a cut on the debt and other things.
I fully agree with Atulji regarding the looking by the regulator. I would like to make one point. When the equities are issued with different class rights, that is also already captured with the MCA that these class rights are there. So at the time of distribution, I think the differential class rights should be given the cognizance in distribution amongst the equity, and above that the other class of who has got the superior rights in case of distribution. So if the inter-se agreement is there, there are some superior rights to other class of equity holders. That should prevail.
But Rajkamalji, those are not secured. Those are unsecured. Those are not secured.
Rajivji, what Atulji is telling, it is only after the
Can we take
distribution.
questions and discussions later?
So probably we should move on.
Yes, please.
Can you allow the speaker?
Yeah, please allow afterwards to your last
It's
question.
an important topic, and you are blocking the entire timeline. Please.
So probably we should move on. I mean,
yes.
any which way, whatever we are discussing is not applicable for IBC. So
yes,
we are looking
correct.
at a forward-looking valuation and not a liquidation valuation.
Correct, sir.
So, I mean, as I mentioned, yes, there is a case happened.
Sir, one question over here.
No more questions will be taken, please.
Okay.
It's considering time. Everything can be parked in the end, please, considering the time.
Shilpa, one thing I wanted to check. This topic is such an interesting topic, and everyone is kind of deliberating. I mean,
so that is because the actual crux is after 10. No, everyone will start going out. Even poll questions have to be raised. I know, I understand, but it's 9:20. We hardly have 45 minutes.
No.
My
request is, can this session be split into two parts? I mean,
okay.
I would like to continue. I mean, since it's so very interesting. I've never seen such a deliberation in a long time. I mean, whatever I've joined. So,
Shilpa, with the doubts we can't go to further. Okay, when we have doubt in liquidation only, when we can, how can we understand further?
I mean, can Atulji consider? I mean, maybe taking a separate session also. Should this be extended?
Just put your suggestions in the chat box. Can I request Atul to continue, please? Atul, can you please continue?
Sure.
Just put all your suggestions in the chat box, please.
So probably, I mean, as I told you, there is a practical example when the liquidation preference kicked in and the equity shareholder didn't got anything. Just moving on. So again, I mean, it's more example of basically how it works. It's a combination of two different components right now. I mean, one is a bond payoff for given that liquidation preference we have, so we'll be having a specific right at a specific level. And after that, once we actually will have a specific valuation, then the valuation for the preference shareholder will also move in. So it's a combination of two things. One, as a debt holder, what I'll get, and as an equity shareholder, what I'll get. When I say equity means as a holder of a equity instrument, what I'll get. and therefore actually the convertible preference shareholders are actually having both the rights, the debt as well as the equity in this. So what happens, I mean, whenever we have to do the valuation, I mean, as we earlier mentioned that typically we do the valuation basis of going concern. Excuse me. And the basic assumption about the going concern is that the company will continue to move up in the future, and the valuation actually try to capture the future valuations in the entire scheme of the things. Accordingly, when we say series A, B, C, whatever we are talking about, they'll get the allocation basis what could be the value in the future. So the idea is, say a SoftBank invested in Snapdeal at specific valuation. They are looking at not the per se liquidation preference right or any other right. They just wanted to protect the investment, and in the later future they wanted to increase the investment as and when the Snapdeal goes up. So the idea is basically what will be the valuation in future and how that get allocated. But currently, since we are sitting at date or a time zero, we need to evaluate it right now. So the valuation method is such that it actually considers everyone has a call option over the equity value of the company. All the classes of shares, I mean, series A, B, C, as well as equity shareholder have a call option on the overall equity value of the company. And how that is being allocated, that is what it is actually what we are going to discuss in the subsequent slide. So some of the key inputs are, what is the current equity value of the company? Second, when they are going to liquidate, again I'm saying liquidation does not mean the company winding up. It means an IPO, it could be a strategic sale, it could be a merger, it could be. So the key point is whenever there is a change in control will happen. That's a key important point. IPO, yes, change in control doesn't happen, but typically, yes, it actually provides a exit to all the investors or all the shareholders at once the IPO comes. The other key component is, I mean, as I mentioned, that it's a call option, basically, which we are talking about. So typically that entirely works in a risk-free environment, and therefore the risk-free rate of the valuation subject or the geography where they are functioning. Dividend typically happens to be nil for a startups, unless until there is a specific case it can be considered, but normally it's nil. Volatility is another key input which is required for this. Typically very difficult to get, but yes, you need to look at the comparable company and add some additional risk premium for an early stage or something if you can. I mean, that depends. And then in the option scenario, then there is one more point which is called the strike price or the exercise price. What is that? I'm just coming to that on the subsequent slide. So the most important point in this entire thing, what will happen? I mean, we said that whatever the valuation is, first of all, the amount will go to series C, then the amount will go to series B, then the amount will go to series A, and then the equity shareholders will come in. Once the equity shareholders will come in, they'll get a specific amount, or is it that the entire amount will go to them? So we actually, first of all, need to compute the inflection points. At what inflection point the behavior of a specific series or a shareholder will change. And those inflection point, actually, we need to put it on the piece of paper or whatever typically those inflection points are referred to as the breakpoints. And basis those breakpoints, actually will compute the overall valuation of the company. So say suppose, I mean, we initially mentioned that initial amount, the breakpoint one will be that the initial amount of 100 will entirely go to series A. Sorry, series C, my bad. Series C. Now, in case if entire amount till 100 is going to series C will, the valuation to series C will not matter till the time the valuation of the company is from 0 to 100. And therefore, the series C or the first breakpoint is going to be 100. Is it clear? Moving on, the second breakpoint is anything from 100 to 150 will go to series B. So that means the second breakpoint is 150, which is primarily coming on initial 100. Breakpoint 1 is 100, which go to series C. Then the second breakpoint, 100 plus 50, 150 is the second breakpoint, which anything between 100 to 150 will go to series B. And after that, 10 million will go to series C. So the three breakpoints is 100, 150 and 160. Till the 160, the level of or the equity value is 160 million, the entire amount will be distributed as a liquidation preference to the preference shareholders.
Atulji, I have a very basic question. Could you please go back to the previous slide, please?
Sure.
You know, when you are telling initial 100 million, is it the valuation of the company 100 million or investment 100 million?
It is a valuation of a company. Sorry, it is a valuation of a company, which is 100 million. So in case if the valuation of a company is anything between 0 to 100, everything will go to series C. The liquidation preference right is such that the initial 100 will go to series C. After that, 50 million will go to series B. And after that, 10 million will go to series A.
That is the amount of investment by that series preferential.
Yes.
Yeah, that's correct. Yes, that's correct. Now what happens? We said that in case if they are actually going to behave as a preference shareholder, they'll get the liquidation preference and then the amount will get allocated towards the equity shareholder. The entire amount will go to equity shareholder. The answer is no. What will happen after that? The common shareholders will get any amount which is equivalent to the amount which they invested. So suppose if you are talking about that series A came in at a valuation of 4 per share. Now, till the time the common shareholders or equity shareholders are getting $4 per share or 4 rupees per share, they'll get the amount once any amount which is over and above the 4 for the common shareholders, series A will convert into the common shareholders. So just try to understand when the series A will convert to common shareholders. Till the time the amount or the common shareholders are getting anything less than 4, nobody is going to convert. Once the value for common shareholders or equity shareholders goes beyond $4, which is equivalent to the liquidation preference per share for series A, they'll convert. Am I clear on that?
This point has to sink in, so we are all thinking now.
No.
So can we say that from anywhere between 4 to 12, they'll become actually common shareholders, series A will become common shareholders?
Yeah, that's correct. That's correct. So I'm saying till what time they'll not convert. They'll not convert till the time common shareholders are getting anything less than that. Less than 4 million. Sorry, $4.
So basically, until liquidation preference per share value, they won't convert, right?
Yeah, that's correct. Yes. And I won't say preferential until the liquidation value is reached, they'll not convert.
Yeah.
So they'll convert at 200 million of valuation. I mean, if you look at it from here.
So
in this
there
case,
can be possible scenarios where series A wants to convert, but series B and series C won't convert, correct?
Yeah, that's absolutely correct. We will come to that. So just going step by step. So ultimately, the initial 3 are very clear, which were equivalent to the liquidation preference. Then when the series A will convert, series A will convert whenever the value goes beyond 200.
Sir,
200,
now,
sir.
Yeah.
Sir, from a compliance
200,
perspective,
yeah.
From a compliance perspective, let's presume that we are doing this valuation for the purpose of MR, where shares are being allotted or transferred from a resident to a non-resident, equity shares, and let's presume that the equity value is coming to 100 rupees, dollars, or whatever. There are equity convertibles also. The convertible investment is to the investment to the extent of, let's presume, $100. So now the equity value is $100, and there are convertibles which are also invested to the extent of $100, which means the common shareholders' value by considering this liquidation preference will be 0. Which means, is it right to say that even if the resident transfers the common shares to a non-resident at 1 rupee, would it be considered to be at above the fair market value? And would it be sanctioned? Would we get the sanction of
So Uttam, can you hold that question? Can we just
doing a transfer?
Uttam,
So,
Uttam, can you hold the question?
Sorry.
Atul, can I request? See, on this breakpoints, now let's understand the breakpoint bit first, Atul, because this is very important for us. And then let's go to the FEMA question, if you don't mind, please.
Yeah. Otherwise, our thought process will get broken here. Yeah.
So I've understood, Uttam, I hope you don't mind this. Let's just have a look at this. So the breakpoint, what you've mentioned, Atul, is that we've come to 160. 160 is good. We have all understood that. Now, why you're taking 40 here is because you're taking out the 10 million which has been invested and only the balance amount you're putting in here. Is that a way to look at it?
No. Okay. So what we are talking about, initially look at what is the LP per share. LP per share is 4, 12 and 24. So that means the series A till 160 were generating or were able to get a cash flow of $4 per share at that till that point. Now they'll actually convert whenever the value for equity shareholders are in excess of $4. 40 is basically 10 is the 10 million is the overall number of shares issued to equity shareholders. 4 is the value for the preference shareholder, the lowest liquidation preference available value. 4 multiplied by 10 is the 40, and that is giving us a valuation of 200.
Got it.
How did you get 4?
Now, 4 is the issuance price or the LP per share for Series A.
Well, Series A value.
Yeah. So Sheetal, if you had
Because
taken that
is,
photograph earlier, you would have that, no, $4, $12, and $24 are the 3 issue prices of Series A, B, and C.
So that is also coming in the slide. Also, if you look at LP per share, the third or the fourth column, it 24, 12, and 4.
Yes, got it.
But why we are assigning this?
So what we are saying?
Why we are assigning the value of $4 to common stock?
Sir, but common stock is valued at 0.1.
No. So we are assigning a value of 4. So what we are trying to look at what point in time the behavior of a series A, B, C or preference share will change. They'll only change so everybody want to maximize their interest. Simple as that. They'll change only when they look at it that yes, I might get a higher value than what I got in the or through the liquidation preference. For Series A as a liquidation preference got a valuation of 4. Whenever they look at it that yes, instead of liquidation preference, I need to move towards the equity, they'll move towards the equity whenever the equity shareholders are getting a value which is more than 4, which is equivalent to their liquidation preference. So in case if equity shareholders are getting a valuation of 2 or 3, they'll not convert. They'll convert once the equity shareholder get a valuation in excess of that. When will you convert? You want to maximize the benefit? You got an initial $4. If the other party is getting more than 4, you will prefer to jump and move on to their side. And that is what they'll do. When equity shareholders will get $4, say 200 million. Yeah.
Sir, but otherwise they will lose everything now. See, if we have invested at ₹4 for converting the equity share, they have already received their investment at 10, whatever investment they have done, like 10 million which they have invested. They have received entire amount. Okay. Now, whatever they will get is beneficial for them. Why they will wait for 4 rupees, even if 1 rupee is the value?
No. Okay. So I'll tell you basically what will happen. In case say the valuation happens, I don't know what is the current valuation of a company right now. I know that yes, this is the starting point right now. This is the current fair valuation. In future, what could be the value? I don't know the future valuation. I mean, I don't know what will happen after 5 years. The value can go up, the value can go down. Say suppose currently if we are talking about 500 million is the overall post-money valuation, the valuation can increase to 1,000, can increase to 2,000, can increase to 5,000, or can go down to, say whatever, 10 million, 15 million, 100 million, whatever it could be.
150, 160.
Now what we are trying to evaluate, it could be anything. It could be anything from 0 to 10,000. It could be anything. I'm not getting to that.
Yes.
What will happen? How will I behave in a specific valuation? In case say after 5 years, the valuation happens to be 100. I don't have any right. I'll simply, the entire amount will go to Series C. In case the valuation of company happens to be 100. In case if the valuation happens to be 250, suppose 250. Do I want to convert? Probably I'll convert, because at that point in time, Series C and Series B will get amount equivalent to liquidation preference. Equity shareholder without or after paying off the liquidation preference will be getting a higher amount than my liquidation preference of Series A. And if equity shareholders are getting a higher amount, then I'll convert, because that's a right which I have. I'll convert into equity shareholder, and I'll try to maximize my benefit. At 250, might be equity shareholder are getting, say, a valuation of 8, suppose, right now, only for a discussion purpose. So I'll move to that 8 per share, and I'll get that value.
Okay.
So I'll convert. At what point I'll convert, and at what point I'll change my behavior. That is what we are trying to evaluate it from here, at a different levels of equity valuation.
Essentially, we are saying that if I have come in at, let's say, $4 per share, correct? And at the similar point of time, equity shares are getting $6 per share. Rather than taking 4, I'll go in for 6 and convert myself.
Yeah, that's correct. Yes.
That's what you're saying.
That's correct. This is what I'm saying.
Exercise my $4 option. I'll say that, wait, we have crossed 150, and since we are getting 250, I'll not encash at $4. I'll encash at $6.
Whatever is the amount which I'll get as an equity shareholder, which will be higher than $4.
It will be higher than $4. So that point I'll convert, because I'm at 250 level, right?
Yes, yeah, that's correct. So at 200, after that, Series A will start participating as a equity shareholder. What will happen? Series B will start participating as equity shareholder once the value for equity shareholder and the Series A shareholder happens to be $12. And similarly, Series C will start participating as equity shareholder once the valuation actually for all the shareholder taken together is in excess of $24, which is the amount at which they invested, which we were talking about earlier, that they invested at a 500 million valuation. So once or whenever the valuation of a company increases or goes beyond 500, they'll convert and they'll look at the upside which a normal equity shareholder is getting. So these breakpoints. So the key step is the breakpoints which we need to create, and this is what we have created, the breakpoint. So this is just an explanation, basically how the breakpoints are being created, and what value will go to whom. So what will happen? If you are looking at the table, it is just a pictorial snapshot, basically how the division will happen at a specific valuation. So when we said initial valuation of 0 to 100 will go to Series C. Now there, if you look at in table 1, we are talking about, say, breakpoint 1, the entire amount will be allocated to Series C, or probably you can actually, look at the table, second table right now. The entire amount is going to Series C. A, B are getting nothing, Series C are getting everything. In the second, say from 100 to 150, the entire amount is going to Series B. 150 to 160, the entire amount is going to Series C. That is what we are actually putting it right now. From 160 to 200, which we are earlier discussing, the entire amount will go to series or common stock, equity shareholders. When I'm talking about common shareholder, that is equity shareholders. So the entire amount will go to common shareholder. After that, the amount will be shared between the common shareholders and Series A in the proportion to their shareholding. Whatever number of shares Series A and common shareholders have, whenever the valuation actually goes beyond 200 to a specific level, it will actually get shared between common stock and Series A. After that, it will get actually allocated among A, B, C, because after $12, after $4, after $4, Series A will come in. After $12, Series B will also pitch in. And at $24, everything will go to all the series or all the shareholders.
So Atulji, I have one question. Why don't we have breakpoint 7 where Series C is also coming in? Because we have only common shares A and B till breakpoint 6.
Till breakpoint 6, it's not A and B. Till breakpoint 5, it's only A and B. A, B, and my bad. Till breakpoint 3, we are talking about the liquidation preference. Breakpoint 4, we are saying that entire amount will go to common shareholders.
Correct.
After breakpoint 4, we are saying the amount, once the valuation for common actually increases or goes beyond 4, the amount will be shared between A and common shareholders.
Correct.
This is breakpoint 5. Once that amount goes beyond 12, then series B will also come in. And
Correct.
the breakpoint 6 is basically that the amount for common series A is more than 12 or less than 24. After 24, series C will also pitch in.
So why don't we have a breakpoint 7 for that?
The table is not showing breakpoint 7, but per se, if you look at the last line, it is not showing breakpoint 7, but it is showing the all series and the ratio is there.
Rename it as all series breakpoint 7.
So that is per se a breakpoint 7, but yes, I mean, we have not put it as a breakpoint 7.
Meaning that the valuation in breakpoint 6 is 500 million. So anything above 500 million will be, which was the last issue price.
Yeah.
Right. So anything above that, all of them will participate. That's
all
basically what you're saying.
Yeah, that's correct. Yes.
And this participating share nature is very common in the startup.
Yeah, it's pretty common in the startup. That's correct. Yeah. So what we are doing right now, I mean, we have created those breakpoints right now. We'll simply do a simple Black-Scholes models. I mean, which we typically we do it for option valuation or ESOP valuation, which we all typically do. These are the inputs which we'll consider for the Black-Scholes. Ignore the last line of trans value right now. I mean, if you look at the input, say equity value, which we are saying is a 500 million, which was the post money valuation for Series C. The strike price are nothing but the breakpoints which we have computed right now, all the breakpoints. So we are talking about the 7 breakpoints which we are talking about. The initial breakpoint is we have taken it at 0.001. That will remain stagnant. I'll tell you basically why we are taking that breakpoint. And after that, 227 is all the breakpoints which we have considered or which we computed above. One of a key assumption which is taken currently in this example is what is the time of expiration? That is that after 4 years, probably either the company will go for liquidation, and when I say liquidation means either it will go for an IPO or for a sale or whatever it could be. So ultimately, all the shareholders will get an exit actually after end of 4 years. That is the basic assumption. Risk-free rate currently, I mean, probably we had taken a earlier risk-free rate of US $2. Volatility again, ad hoc subjective volatility of 50% right now. I mean, it will be dependent on what are the inputs. Dividend typically happens to be nil for for the startups, and therefore we have taken nil. And then we simply computed what is the fair value of the option using a Black-Scholes, a normal Black-Scholes. These are the inputs and the fair value of option. This is the value which you will get. Now, what we earlier said that for breakpoint 1, whatever is the value till or from 0 to 100 will be allocated to Series C entirely as a liquidation preference. Now, if you look at it, the gap between or the difference between a 500 minus 411, which is tranche 1 fair valuation of option, minus the tranche 2 fair valuation of option, that is $89 million. That happens to be the tranche value. And this tranche value will be allocated to Series C only as a liquidation preference. So what we are saying that all the shareholders of the company have a call option right on the overall equity shares or overall equity value of the company. In case if that is the case, what could be the valuation for each shareholder? Now, if you look at it, this 89 is nothing but a gap between tranche 1 and tranche 2. Tranche 2 is giving a call option value at an exercise price or at a spot price, at a strike price of 100. So the gap between the overall option value minus the tranche 1 or the breakpoint 1 value is giving 89, and that means this value is getting allocated entirely to Series C. Similarly, the 38 which we are talking about the second tranche value in the second column will go to Series B, 7 will go to Series C, 27 will go to common stock, 56 will again bifurcated between A and common stock, 79 will get bifurcated among A, B and C, A, B and common stock, and anything beyond 204 will get allocated to everyone. So,
Atulji, sorry to interrupt. Here we have assumed that the value of the equity value is $500 million in the previous slide.
yeah, that's
So,
correct.
so when we are doing this, applying this method, and say for example, the value is this round of funding has happened 1 year back or maybe more than 6 months old. So we need to do a valuation. We need to arrive at the value of equity first, correct?
Yeah, that's correct. Yeah, that's correct. I mean, in case if it's a recent, then it can be used this way. Otherwise, you need to compute the valuation. I mean, the DCF or the CCM or whatever method you will apply. But first of all, you need to compute the equity value, and then actually this entire method will go on.
So we need to, as a value, so we need to get the value, that value needs to be arrived first.
Yeah, that's correct. That's correct. So once we'll allocate, no, this is nothing but, I mean, which we discussed in the earlier slides, that this is how the valuation is going to be allocated. And we have simply allocated the value. Basically, say tranche 1 is going to Series C, tranche 2 is going to Series B, tranche 3 is going to Series A, 4 is going to common, 5 is being allocated between both common and Series A, then Series A, B, C, and then Series 7, tranche 7 is actually allocated among all the classes. This is their shareholding ratio.
Atulji, I have a question here. In a scenario where there are a lot of options being given, like you go to public round of funding or next round of funding within this much years, then this you need to consider this value. If you go to public within this much this many periods, then you need to consider this multiple for the purpose of valuation. So how in those scenarios the valuation needs to be considered?
Sorry, I didn't got your question. I mean, can you repeat that?
So I have a question where the agreement requires you to consider various scenarios to do. So like for example, you have issued Series C CCPS. Now Series CCPS requires that if you achieve this much valuation in next 2 years, then this at this value this will get converted. Say for example, if you go to public within next 5 years, then the revenue it would be the valuation is to be considered for conversion would be this much multiple of revenue or profit.
Okay, so in that case, probably this will not apply per se. There actually you will require a lot more complex hybrid model, and hybrid is nothing but you need to look at basically what could be the future valuations of a company. Within the future valuations, whether you can go for an IPO or not, and if you are going for an IPO, then what would be the classification? If you're not going for an IPO, then what would be the classification? That is going to be a lot more technical than a very simplistic model which we are currently discussing.
Atul, can I ask one question?
Yeah, sorry.
Yeah, so this liquidation assumes it's an organized liquidation, and then it will be distributed, allocated among the shareholders. Let's say there's a startup under liquidation and it is bought out. So there is some investor who says that I will buy it for 500, which means about say 5 rupees per share. And I will buy it from anybody who sells it to me. I'm not prepared to pay anything more to anybody else. Okay, and he acquires, there are more than 51% who accept that offer. In which case, does this agreement hold, this allocation basis and all? So, because the investor will say, you don't want me to, you don't want to, you know.
So what will happen? I mean, in that case, what will typically happen? There is a right called a drag along right, and that you will find in a lot of or almost all the shareholders agreement. It says that if I want to sell, I'll drag you along and you have to come along with me.
Correct.
And then in case, and therefore at that point in time, the major or the majority of shareholders will go drag all the minority shareholder and sell the company at 500, whatever it is. Once they are selling the company at 500, at the entire equity, 100% equity is going at 500. Then the liquidation preference will pitch in. They'll say that, yes, I mean, my liquidation preference is at $10. I'll get $10. If you don't have a liquidation preference, in whatever leftover amount you will get, otherwise you'll get nothing.
Yeah. So just on the drag along.
And then that is what actually I explained earlier, actually in a live example, which happened with a company called Good, which was acquired later on at a lower valuation.
So in the drag along, is the drag along enforceable? Because the investor is saying, I'll pay this much, and I will buy it from individual shareholders. I am okay with only 51%. You take it, otherwise leave it. And in a liquidation situation, they may not even get that 500 if this investor does not take it up, or it will take many more years, and then that value will diminish.
So I mean, typically, normally it happens only when a case where you believe that the company might not able to actually sustain or move along in future. I mean, say we are talking about example of Snapdeal some time back. Now that valuation came in, and the reason for that is that SoftBank said that yes, I mean, we are not going to fund in future. We all know that all the companies are burning cash like anything, and given that there is no cash availability, either the company will go down the drain and the entire value will erode and it will become zero. So they thought that whatever valuation we can get, we should get it. So it actually happens typically and very oftenly. Normally, whosoever is the incoming investor, they know that yes, I mean, we want 100% control over the company. Otherwise, there is a lot of nuisance value. We say even if I hold 10% or 15%, I know that I can actually go and knock the doors of the company law board and say that yes, I mean, the majority shareholders are oppressing me. So therefore, I mean, they always prefer that yes, I mean, they don't want any shareholders who are going to create a nuisance at a later date. So they always prefer to have 100%, and therefore the drag along actually comes in. So that's a practical scenario. Yes, theoretically it can happen anyways. They can actually acquire 50, 55, 60, 70, whatever they want to, and balance they can leave. But practically, I mean, they do not want any of the nuisance creating shareholders in the company.
So, but this includes practically control premium also. Once he is going for 51%, it includes the price component includes the control premium also. That is why he is offering more, and everybody is willing to.
It has nothing to do with the control premium per se. I mean, typically in case if company not performing, normally it's a distress sale, and then obviously you will get it at a discount. The key issue is that you are getting something in case if you will continue in future, you will not get even that or that pie. So the idea is basically, I mean, you just need to ignore the control premium and all those things that only come in when actually your company is doing good. And then when you actually sitting on the negotiation table along with something in your hand, then actually you can actually demand a control premium. I mean, otherwise there is nothing called a control premium or anything. You just wanted to move out of the company. And then that's primarily a distress sale. Either you will put it IBC or whatever distress sale you put it.
Can I request, Atul, there were a couple of questions which were there, if you don't mind taking a couple of questions just now. One was, I think, Uttam, where we had asked him to just hold off on his question for a bit. And then we have Venkat Gangadhar Rao also. So Uttam, can you, if you're on, can you just unmute?
Atul sir, thanks a lot. I mean, that was an insightful presentation. My question here was, let's say the equity value using one of the methodologies comes to $100 million, and there exists a convertible instrument whose investment was also $100 million, and which has a liquidation preference as well. So if we are trying to do the valuation of common equity because of these conditions, the common equity, since the equity value is $100 million and the convertible instrument is also $100 million, so the equity value will typically become zero. So would that be right? Would it be right to consider the equity value of zero? Yeah.
So that is the entire reason actually why we are looking at a forward-looking valuation. That yes, the current valuation is 100, but what actually it might be in future, and therefore we are not allocating the 100 on the day of valuation. We are saying there could be a possibility that the valuation might actually shoot up, say beyond 500 million. It might be 1,000 million or whatever it could be. So I don't know that. And therefore in future, in case if you have to allocate the value, then what it could have been. And therefore we are just moving from a normal simple allocation at that point in time. We are moving to this OPM scheme, wherein we are looking at the forward valuation and then try to come back to the present valuation. So yes, the valuation which you are going to see for a common stock or a common If you look at the current slide, I mean, it might be at, say, a common is giving it a valuation of 217 million overall. It might be as low as probably a 2 million, 3 million. I don't know that. So as the valuation go down, the Series C, B, and A will get a higher pie. As the valuation goes up, everybody will get an equal distribution of the shareholder. And that is the entire reason actually why we are discussing the OPM and not a simple allocation at that very point. In case if the distribution is imminent, then yes, this entire method is not applicable, and then probably we'll say that 100 million is the valuation, and you simply give me 100 basis the LP, and the valuation for equity shareholder will be nil.
So that means, if I understand Uttam's question better, okay, no, not Uttam, sir. Complete, Mr. Uttam. I'll raise it again.
Sorry.
So what we are saying is a convertible instrument is more valuable than a common equity. Is that what we are saying?
Absolutely correct. Normally, typically, a convertible are more valuable. That depends on the right as well. But you also need to evaluate the rights.
But are we not ignoring the fact that a convertible instrument does not have a control right until it becomes convertible, which otherwise is enjoyed by a common equity?
No, there are two facts in this right now. One, I mean, typically, whosoever investor comes in with a startup, they typically ask for a board seat, or if not the board seat, at least the MIS and all those things. So they kind of actually try to control the company, normally, typically. Even if I don't have a control right, typically the assumption goes that whosoever is controlling the company, they'll behave in the manner which is, or they'll take a step which is most beneficial to the company and not to the specific shareholder. So we cannot raise a question on the integrity of a shareholder who is controlling the company. We actually typically look at that yes, whatever action they are taking, that actually is going for the benefit of the entire company per se. And if the entire company is benefiting, whether I control the company or whether someone else controls the company, the value will remain same.
Adding on to Uttam's question, can we say that if the valuation is going south, then convertible instruments are more valuable? If the valuation is going north upwards, then it will be the equity shareholders and all the series investors. It becomes more valuable. Their holding becomes more valuable.
So equity shareholder will never become more valuable per se in this case, which we are discussing right now. I mean, specifically for liquidation preference and all those things. You'll always see whatever valuations we'll put in, you'll always see that the equity shareholder will get an amount which is either equal to the preference shareholders or less than preference shareholder because of the liquidation preference kicking in. So whenever the equity shareholder is getting higher valuation, the convertibles actually will convert into the equity shareholder and they'll actually enjoy that upside as well. So it is never that the convertibles are going to be at loss. Yes, in case if the valuation is going south, then the convertibles are at a premium.
So using this example, Atul, of 500 million, now the Series A, B, Series C is the one which is at 500 million. So Series A and Series B, will there be an option value which is attached to the Series A and the Series B at a valuation of 500 million?
So this is what we have done. So I'll just come to the subsequent slide. So if you look at this, the per share value, how the per share value happens to be. At a 500 million valuation, we are saying that the common stock is getting a 21.7 per share valuation. I mean, obviously they actually hold the number of shares, a higher number of shares. So therefore, the overall value for them is higher. But the per share value for common stock is 21, whereas Series C is getting a per share valuation of 31. And then Series A, which actually invested at $4 per share, despite actually Series C coming in at $24, they are getting almost similar to common stock, but yes, they are getting a higher valuation than common stock. Typically, you will not see anywhere wherein the valuation for Series A, B, C is lower than the common stock. That's a broad check also which you can do look at.
And the difference is the option value.
Yeah, that's correct.
Right. So then the question would then arise as to the parameters which we've used in the option valuation. For instance, you have used life for 4 years, number one. Number two, you use volatility. Number three, you've used interest rate of 2%. If we were to apply this to Indian scenario, what would be a realistic number to use for volatility?
So let us go one by one. I mean, the risk-free rate will be basically what is the bond yield, 10-year bond yield for the RBI. So I mean, that is something probably whatever currently it might be 5.7. So you just can take it from there. Whatever it would be. In terms of the time, I mean, that depends basically on the phase of company where the company right now. In case we believe that yes, the company will take 4 years to mature, then you will take that. But in case if you believe that the company has matured and the valuation is pretty high, then yes, you can actually look at the lower period also. I mean, probably 3 years or 2.5 years or 4 years. So that depends basically the stage of the company. The volatility, clearly the most tricky part. We actually need to look at the startups or the company which is clearly in the expansion mode. Unfortunately, in India, you won't find those companies. And typically, globally also, if you look at it, the startups typically are not listed. So either you can go global and look for the companies, say like eBay or Amazon, or say, whatever Airbnb actually got listed recently. So either you can look at that. You can even look at in India, say the companies like the InfoEdge or Just Dial or Infibeam and all those things. So try to look at basically which are the companies which are per se in a new age scenario, more or like a new age companies. And then if you just can actually adjust that by say applying a 10% ad hoc number or something like that. So ultimately the volatility for all the startup actually tend to be a bit higher as compared to the mature company. So in India, yes, that is a challenging part right now and a difficult part. There is no concrete answer to it. Depends on the valuer discretion, but that is how actually typically we look at it. That what are the new age companies in the market and what could be the volatility for those.
Thank you.
So here in this slide, there is a different values for Series A, B, C, and common stock.
Yes.
So can we say that these values are different because of the differential rights which is attached to them?
Yeah, that's correct. Yes, that is the reason actually why the values are different, and that is common stock will always be the least value, and Series A, B, C will have a higher value depending on the liquidation preference and the seniority. Even if at whatever valuation, so we did it on 500 million. Even if say we would have actually done it on say 5,000 million, then also probably 2-3 decimal points, and then you'll see that common stock will have a least value, and CDC will always have a higher value.
And in a scenario, we have considered the term as 4 years in this example. So that term is being determined based upon expecting that the Series A, Series B, and Series will get converted, or they will go for IPO.
So it's basically from a company perspective when they're able to give an exit, and the exit, typically everybody would like to maximize their benefit. So after 4 years, the company might be actually at a stage where it might go for an IPO or a sale or whatever it would.
Generally, startup has a period of 12 to 15 years to give exit to the investors.
It is not really that way. I mean, it all depends basically. And if you look at the unicorns, the time taken is actually slowly and gradually is collapsing. So suppose if I talk about White Hat Junior, they gave an exit in span of less than 2 years or less than one and a half year even. So in span of 14 to 15 months, they actually gave an exit when it was acquired by Beju. So that depends basically. White Hat Junior.
Okay.
It's a decent example. Probably happened sometime in September, October. You can have a look at it.
Okay.
Now the key. Sorry, we are running out of the time. So the key out here, if you look at it, we said that 500 million. They actually CDC came in at 500 million, and if we'll apply this method, the valuation for CDC is coming at $31 per share, though they actually invested at $24 per share. So that means the actual value of the company is not 500, but something else. And that is, so currently whatever we discussed was all about OPM, the option pricing. Now what happens in case if the valuation of the company happens to be, or the CDC is $24. Now we need to look at what is the valuation of a company in case if Series C happens to be at $24. And that is where typically we call it a back solve. So we try to do a iterative working and arrive at the valuation of a company which will give the Series C a valuation equivalent to $24. And if Series C happens to be $24, the valuation of company happens to be 308 million. And the valuation of our Series B, A, and common stock happens to be at 14, 12, and 11. So the critical part, though we have been talking about that a Series C invested at 500, 500, 500, optically it might be correct. But actually the valuation of a company is 308. And if you have to value it basis the rights, the entire valuation undergoes a change. Yeah, Ramesh, sorry, you are raising the hand.
Yeah, hi Atul.
Yeah, Ramesh.
So just want to understand. So basically, if we have to factor into IRR, how to factor that IRR into breakpoints?
So Ramesh, I mean that this model will not be at all applicable in that. I mean, it will be a hybrid model, which will be a combination of so one actually we need to do a Monte Carlo and then we need to apply the CVM. So it will be a hybrid model. Nothing of this sort actually will be applicable in that.
All right, sure. And one more question, probably at what point of time probably the IPO is certain whether this model is we can use or
sorry, I didn't got your question. You said that.
So basically, if IPO is very near and it's the company have started preparation and undertaking the filing, so basically IPO is very near. Whether we should use this model or the PWERM is.
P1 is more applicable in that in case if company is not looking for a future fundings. I mean, this typically model is more applicable in case if you are looking for a 5 to 6 year when you believe that yes, future fundings will come in and the future is uncertain. I mean, if you know that that probably IPO is imminent, or for that matter, I mean what is the future outcome of a company, then a P1 is more applicable.
All right, Atul, thank you so much for this.
Atul, sure. Yeah, listen here in a scenario where the value of the equity value is not unknown, is not known. Then how we get the value? Then we do this valuation.
No, so equity value, you need to actually have the equity value. You can't actually work on a model without the equity value. I mean, the initial first step is the equity value.
So to derive that equity value, we have to consider CCPS.
Sheetal, 1 second. Sheetal, while Sheetal's question is being raised, I request all the participants to participate on the poll. I know it's a very wrong timing, but then we are running short of time. Sheetal will be sharing her question. Meanwhile, the poll will be launched. Once her question is over, then we'll go for the next poll. Sheetal, go on.
Yes, sir. Actually, I was asking to derive this equity value, what is the CCPS terms and conditions? How should they be taken into consideration?
So the concept is, first of all, you'll arrive at the equity value and then you'll allocate that equity value using the terms of the CCPS. So once you'll have the equity value, say using a DCF or a CCM or a CTM, whatever method you'll apply, after that only this entire modeling will come into play, not prior to that.
Okay.
Atul, I have a question here where we see companies like unicorn companies, or we say startup companies, they generally don't make profit in couple of years. I'll say next 5 to 8 years or maybe 10 years, right? Because these are new industries, so we need to burn money for the purpose of making money. So in those scenarios, do you think that DCF method is the right appropriate methodology to determine the value?
So there are different methods actually to value the startups. I mean, it can be captured subsequently, but there are a lot of different methods actually to value those. DCF is one of them. You probably will not use the same DCF the way you do it for a mature company. And there would be a lot of adjustment to that. I mean, one adjustment which we earlier discussed could be the exit multiple, could be H growth model. The WACC and everything will be different for that. So I mean, there'll be some customization to the DCF which we need to do for that.
Correct.
But DCF could be one method.
Yeah, right. So actually I have a question on that, like we take an example of Byju's, right? Or maybe Oyos. So those companies are having a turnover of maybe, say, for example, Byju's having a 2,000 crore turnover, top line is 2,000 crores, bottom line net is 2,500 crores loss, right? And we are getting a valuation of 50,000 crores, or maybe 75,000 crores. So even
So,
though if
ultimately, the key issue out here is that the valuation is not dependent on what historically you achieved. Obviously, yes, that is the key parameter which you need to evaluate. But the valuation is also dependent on the future growth prospects. And in case if you believe that the Baiju is growing rapidly and the kind of growth which we had seen, say, for Baiju, so that actually also need to be captured in the valuation. But per se, therefore, the current profitability and current revenue might not be the appropriate method.
Correct. I agree. So in a scenario where the environment is changing so fast, technology is changing so fast, right? We in today's world we say 2 years is a very long period of time, correct? So do you think that this valuation which we are assigning based upon the future growth is something that carries a lot of weight, because we don't know, like you take an example of Oyo. So Oyo in December 19 and December 20, the valuation might be depressed by more than 30% or maybe 40% in medium term.
So probably that's your call. I mean, I doubt that the valuation of Oyo might have gone down. But yes, I mean, we can take a practical example. Say WeWork, the valuation of WeWork was expected at a different level, and when they went for when they wanted to go for an IPO, the valuation, what they realized is the valuation is a lot lower. So yes, I mean, the valuers and everyone can go wrong, or the valuations can go down, but that is the way actually the industry works. So we cannot say that. I mean, there is no value to that, or we are the gods who are valuing the company.
Okay.
I mean, the valuation can go wrong, but that is the actually you need to value the company. I mean, we'll have probably more success stories as compared to the failures. I mean, wherein we are saying that the valuation has gone wrong or significantly wrong. So, I mean, the Airbnb actually got listed. Other companies also got listed.
So don't you think that under these circumstances, when hospitality industry is so badly affected, the valuation of Oyo would have gone down considerably?
So as I mentioned, actually, I mean, one, it's a temporary phase or phenomena right now, which we are looking at, and probably once we are out of the pandemic, then everything will be back to the normal. The second thing, I mean, we need not look at, basically, we need to evaluate basically what could be or where could be Oyo sitting after 5 years or 10 years down the line. So that growth which we are talking about is the most important part for the entire valuation. I mean, why we say that the multiples say for the multiples for mature companies are not lower as compared to the tech companies. The answer is basically that we believe that the growth is going to be a lot higher. So the growth driver is the key for that.
No, valuation means valuation as on date compared to the past, I am saying.
So again, I mean, whenever you are valuing the company, you need to capture the future growth also. And that is why actually we do not go on the replacement cost or the cost of replicating or of cost approach. Why do we look at the DCF approach? We just want to evaluate basically what could be the future cash flows in the company.
Thank you.
Sir, can you throw some light on share warrants, because nowadays companies are issuing share warrants also. So how would be the valuation of share warrants done?
Share warrants are more like options typically. Typically they have an exercise price or they have a target or something like that. So it'll be more like options, and then that is how you will value that.
So even if it comes with the mandatory requirement of exercising, still it will be same options only.
It is not necessarily required to be exercised. It's an option given to the warrant holders.
But as he said that it need not be, we need not go with the nomenclature. So if the terms of share warrants is such that it has to be mandatorily exercised, so in that case, will it still be considered as option?
So in case if it had to be considered, if it had to be mandatorily converted into equity, then you can consider that as equity only. I mean, it's either a partly paid equity share in case if something will come in future, If there is no spot, then I mean that's nothing but equity at a future date.
So that means the value will be same as equity, irrespective of term when it is being exercised?
I'll not say value will be equivalent to equity. Equity typically can be sold at that specific point in time. In case if warrants are freely transferable, then also, I mean there happens to be a bit of difference in the warrant vis-a-vis equity. The value might be lower. You can actually apply a subjective discount, either a DLOM or something like that on that. But typically it should be a bit lower than equity. In case if nothing is payable and that is mandatorily convertible into equity, then also there will be a slight discount to that. I mean, depending on when it will get converted into equity.
Okay, so by when you mean that longer the period, more the discount could be possibly.
Yeah, that's correct.
Okay, thanks.
Mr. Atul, can you just see the present poll question? Optionally convertible instruments are subordinate to equity shares. What is the right view for this?
So optionally convertible instruments are subordinate to equity. I'll probably say it's wrong, false. The reason being that the convertible instrument, as we were actually earlier discussing, will always have a higher value to equity shares.
They stand benefited even in the worst situations.
Yeah, that's correct. Yes, I mean, so they have a redemption right, and therefore, I mean, the value should be high.
But until they are converted, they cannot participate in the management, so they cannot be considered as equity, which means they will not have a high risk as that of equity, which means the value should be low until they get converted. Do we not give credence to that point?
So what we are saying from economic perspective, until they are not converted, till what time they'll not convert? They'll not convert till the time the value of equity share is lower than the redemption value. In case if the value exceeds the redemption value, they'll convert. And then that means they'll become a better than the or equivalent to equity share, or they'll be better off in case if the valuation of equity share is less than the redemption amount. And in terms of the control, I mean, as I earlier mentioned, that from a control perspective, typically whosoever controls the company, the basic premise is that the controlling shareholders or the board will actually behave in a manner which is most beneficial to the company. So I think actually we are done, and we have just moved ahead of the scheduled time. So these were the primary slides. I mean, obviously, yes, there are a couple of other slides which I had, but probably just wanted to discuss the OPM and hope it was useful for all of you.
Yes. Can you see the poll question? What is the right answer? Value of bond just depends on interest payment it offers.
So again, it's false because the interest payment, along with that, basically the bond, one, we need to look at the conversion terms. Second, I mean, whenever bond we are talking about, there will also be a principal or principal amount refund. So the interest payment is only a one component. After that, you also need to look at the redemption value.
And also the time period also, right? Holding period of the bond.
So that actually probably will get captured between the coupon rate and the redemption amount. So probably the tenure might not matter, but ultimately it's the terms, what kind of a return you are making.
For the benefit of the participants who are not aware of this abbreviations, can you just highlight? OPM is option pricing. Others.
OPM is option pricing. The answer to this question is yield method. Yield method is nothing but it's more like a discounting or a DCF method, which we say that yes, I mean the future coupons is this and the redemption amount is this. So the answer is yield method. PWAM is probability weighted earning method. I mean, which probably Ramesh was discussing earlier. In case if there are different classes of the shares and the company is nearing an IPO or an exit stage, then probably the PWAM is applied. CVM is current value method. In case if the exit is imminent and then we are just actually about to exit, the transaction or the evaluation need to be done for the exit right now, then OPM and PWAM will not be applied, and then the CVM will be applied. So in that case, actually, you're not looking a forward-looking call. In PWM, you are making a forward-looking call, but probably for a smaller period, or smaller term or smaller period. And I mean, OPM, you are taking a forward-looking call for a 4 or 5 year period, wherein the uncertainty is more as compared to PWM or CVM. CVM, there is no uncertainty around that.
And this first poll question, does equity shares and preference share carry identical value?
I mean, this is what we have been discussing, that I mean, the value for equity share is always and typically tend to be lower than the preference shares. And this is what we have been discussing in this entire presentation.
Sir, do you have any good literature where we can get some ideas about this kind of valuation or something? We need to do a hands-on experience only.
Any specific book or any web?
So I mean, there is a guidance typically referred to a cheap stock guide. You can actually refer to that. It's a very good guidance actually from AICPA. And you can refer to that, and they actually will take care of the OPM, the other method like PWM or CVM, which we discuss, or even hybrid. So you can actually look at AICPA cheap stock guide.
AICPA?
Cheap stock guide. I mean, typically it's known as that.
Is it chief or cheap?
Cheap.
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 Okay. This poll number 3, the one which I have shared on the screen, you can just highlight whether this is the right.
That is correct. Yeah, that's correct. I mean, so convertible instruments are recognized as hybrid because they have a property of both debt and equity. Debt when they're actually looking at the liquidation preference, equity when they convert. So from a valuer perspective, I mean, from accounting perspective, it could be a bit different.
Any other person has a doubt on any poll question? I'll be closing all the polls now. Yeah, Mr. Atul, I suggest you can finish your slides in case.
How did you get 1 or 2% in that? That was the question.
It's 104 actually. 2% has also voted for debt actually. So overall, it's 104%.
Because one person is joining from 2 devices, maybe.
Oh, maybe. Correct. It will recognize as one person only for one ID, email ID.
Yes, yes.
So couple of slides actually. I mean, this was the key intent actually, which I always wanted to discuss. So I mean, typically, normally what we see that yes, there is a discount. I mean, it's more basically what we discuss. And then typically we get a discount in the range of 25 to 35. There is no thumb rule per se. The discount could be as high as 50-60%. The discount could be as low as 10%. That depends, one, on the valuation, and two, basically what is the stage of a company, and then what are the rights. So it will just keep on varying. And then that is something. So I mean, again, a practical example, and again, I mean, that's there in the public domain. So SoftBank actually acquired the Uber shares somewhere in 2018 or 2019 at a 2 different valuation, wherein the junior stock were acquired at a 30% discount to the primary infusion. And then that's a practical thing out there in public domain. Primary infusion happened at a valuation of about 68 million. It was billion actually, not million, sorry. And then the primary happened at a 48. So that's a practical example. You can actually look at it in public domain. Some of the methods actually which you can apply for a different instruments. So say CPS, I mean, a convertible preference share. I mean, as I earlier mentioned, don't go by the nomenclature, look at the rights, and the rights will decide basically which method you can apply. In case if it actually meet to fix criteria, means fix to fix means that the conversion ratio is fixed, then typically it is recognized as an equity. Yes, other rights also need to be evaluated, like say anti-dilution right, which will change the nature from equity to debt. I mean, so other rights also need to be evaluated. And in case if it is say equity, then you can actually apply either a OPM or a hybrid approach. In case say, even if we are talking about the convertible preference share, which is which is convertible at fair market value at the time of, or prevailing at the time of conversion. Now, when we say it will convert at the fair market value, that means, I mean, one, the conversion is variable and it does not meet a fixed to fixed criteria, and therefore a yield method can be applied. In case if we are saying that convertible at an IRR of 20%, again, the stock is variable and therefore yield method can be applied. So we just actually try to capture basically some of the instances where actually you can apply a different model depending on the different rights. The key issue is the rights are the foremost. What are terms for conversion? What are terms for redemption? When they'll convert? When they'll redeem? All those things need to be evaluated from a commercial intent and nothing from a nomenclature perspective. If you want to go further down the line, I mean, yes, there is a value for a down round. As I mentioned, you can also apply a Monte Carlo, and then using a Monte Carlo, actually, you can actually apply a hybrid. Obviously, that actually becomes a lot more technical as compared to what it is right now, or what we discuss. What we discuss is probably the most simple method actually, or a simple computation. Applying a hybrid is a lot more technical. Say for example, and typically hybrid is applied actually when you say that, I mean, the future conversion will happen in case if this milestone is achieved, then the multiple will be this. If a future milestone is not achieved, then the multiple will be this, and all those things. So that's all from my side.
Any participants who would have directly approached me, but then I wouldn't have been able to direct it to the speaker. So if you have any doubts, please raise it to the speaker now.
Atul, you mentioned that few of the examples of valuation is they're available in the public domain. So which website or where can we go to read this and study this? I mean, is there a repository or something that you often use?
So there is no there is no repository, I say. I mean, when I say examples in public domain, I mean, you can actually find it over Google itself. I mean, these are the live examples at SoftBank investing in Uber. So you can look at that. Probably yes, after the IP and all those things, I mean, that might have actually figured out. Say good, the example of good which I gave in, I mean, again, actually that actually primarily came from Google. From a theoretical perspective, yes, I mean, as I mentioned, that you can go to AICPA website, buy the guide from there, and you can actually go through that.
Sir, I have a question. Am I audible?
Yeah, sure.
Yes, sir. When we started this whole exercise, we started with a equity value of 500 million, right? And now after doing this backsolve method, we arrived at 308 million as equity value. So my question is, what is the actual equity value? And secondly, what does this difference between 500 million and 308 million signify? What is this difference? What we can attribute this difference to what, like?
Okay, sure. So what happened? I mean, we initially said 500 billion, and how we got to 500. The total number of share multiplied by 24, which is the investment amount or value per share invested by Series C, and that is how actually we arrived at the 500 million. And after that, we said that yes, Series C have a superior right than Series B, A, or common. In case if they have a superior right than Series A, B, or common, then there is a value for those rights also. If we'll adjust the equity value, or if we'll remove the value for those rights, then the value for common Series A and B is going to be lower than that. And that means the value for common is not 24, but probably lower. And that is how actually we arrived and did the entire working. And we arrived at a valuation which is equivalent to 308. So the correct valuation of a company is 308. Optically in media, which you look at, typically in media, you always look at the 500 million valuation. But if you'll change the rights, if you'll do the proper valuation, the valuation is 308 and not 500 million. 500 does not capture the value of rights. And that is why it's a wrong computation.
Okay. One more question, Mr. Atul. Suppose there is an existing private placement of CCPS with certain rights, okay, and it is done, by a registered valuer under Companies Act in compliance with, Section 247, 62(1)(c), everything. Okay, so in this kind of valuation, should as a registered valuer, we give the equity share considering that what is expected out of us is a conversion price. Okay, at what price the CCPS is supposed to get converted, which is being fixed now. Is this what we have to give equity value, or considering that, what is the value of CCPS, that is the report to be given? So because this is a very common assignment everyone gets, so can you throw light?
So the idea is basically typically whatever we are talking about, in case if the company is to issue the share, we need to look at what is the fair value of the share which is being issued. In case if you are issuing a CCPS, then the fair valuation of CCPS need to be considered. If you are issuing equity share, then the fair valuation of equity share need to be considered. So it is basically that we need to go again, fall back upon the crux, basically what we are doing and why we are doing it. If you are doing it for the issuance of CCPS, then CCPS need to be considered.
So your conclusion, your idea is when we are going for CCPS issue, CCPS has to be valued and not equity share.
Yeah, that's correct. Yes, I mean ultimately that is the ask. The ask is not to value the equity share. The ask is to value the CCPS which is being issued.
But sir, in many a times, those companies, they ask for the valuation of the company based on which they will decide whether they want to go for CCPS or equity or different kinds of instruments.
Even the pricing we will not know, or sometimes terminology also may not be frozen because they want to identify the valuation, then approach the investor, then arrive at a negotiation price. In that case,
so in all the cases, I mean the valuation will keep on changing depending on the terms. I mean, the key issue out here typically is basically, and then what typically the company looks at, what is the overall equity valuation of the company, and then move on. But yes, if the terms are changing, then yes, I mean the valuation will keep on changing. So I mean we can't avoid that.
Mr. Atul, I have got a question which is related to my previous question only. The way you said, as on present date, if we take, it is only the hospitality and the airlines which are the worst affected. And when you say that the future cash flows are to be discounted, which exercise is primarily done to arrive at the present value, do you think that any buyer of these two industries as on date would give the same valuation which he was willing to give 1 year back, if at all someone wants to acquire any of these industries as on date?
So
when you presume that there is no effect on valuation because of pandemic.
So there are 2-3 things in this right now. I mean, if you look at the airline industry, or if you look at the hospitality industry,
Oyo we were talking at that time.
I mean, I'm talking about any company. I mean, be it Oyo, be it Indigo, or be it Airbnb or whatever.
Right.
What kind of a valuation Airbnb has got actually in the market? And after listing, how the movement of or the stock has gone up for Airbnb. I mean, that is right there in the market. So they have got a valuation, a pretty high valuation, which was somewhere a lot similar to what they were actually getting last year. And after listing, actually the stock went and rocketed. So that is where we are right now. I mean, ultimately the investor will always, or as an investor, actually we should always look at what is going to happen in future. Ultimately, the stock market typically acts as if they are actually sitting six months ahead of the current scenario. We always look at basically what is the underlying and how the underlying is going to change beyond a period of time.
Those are the listed ones. Here we are talking about not the listed ones. We're talking about the growing ones.
I am saying that why do you believe that the listed ones, in case if listed ones are getting that kind of a valuation, then why the unlisted will not get that valuation?
I mean your presumption is still that one will get the price for Oyo what he was getting a year back.
So I'm not saying probably the year back the value will remain same.
No, pre-pandemic level. I'm saying
pre-pandemic level. So yes. that entirely depends basically where they were at that time, where they are right now, what changes they have made actually in their business model. Are they going gung-ho about the China, or are they going gung-ho still about Japan? I mean, they want to expand in Europe. in case if they have actually taken the step back because of cash, because of pandemic and all those things. So all those things need to be considered. But
even their
saying
investors
that,
have backed out.
So again, I mean, if the investors have backed out, but they still are actually raising funds.
So that
They have
in
actually
itself
raised
is
funds in
a hint
December.
enough that it's all going wrong.
So this is what I'm saying. I mean, yes, I mean, it's an endless discussion. We can keep on going, but they actually raised funds in recent past. After the pandemic also at the same valuation or similar valuation. They have done that, and that is there in public domain. Again, that is there in public domain. OYO has raised funds somewhere towards the end of FY20 or when I say FY20, sorry, CY20 at a similar valuation, which they actually were raised actually earlier prior to pandemic. Similar valuation. Again, I can't recall the exact valuation, but similar valuation.
Even in case of this listed ones, as you are talking, there are owners which are buying back their shares just to maintain their value, to keep their valuation intact.
I'll
indirect way of manipulating the shares
so
valuation.
I'll probably differ. I'll not say that they want to manipulate it. I'll say that they feel that the value is a lot higher and the current market prices are different.
Yes, that is how you interpret it.
So I mean, it all depends basically the way you want to do it.
You want to interpret it.
But my perspective of valuation, I mean, and that's my personal perspective, that we always look at the long-term horizon rather than the short-term horizon.
Right.
That's a personal perspective.
Right, correct. Thank you.
We can take last one more question before we wind up. If anyone has very quick question, please. It's already 10:30. Yeah, I request Mr. Ravindra to go ahead and give vote of thanks.
Yeah, let me do the honor, Shilpa. Thank you very much, Atul. It was indeed a wonderful session with quality deliberations, and all the members actually were left with a quest to know more about these complex instruments. You took us through, started with the fundamental valuation and explained approaches to valuation. Then actually you gave us the importance of startup valuation. Actually, that strikes us more because most of us are amateur valuers, and only the startup kind of valuations come to us. And it was also very nice of you to, in between answer a lot of questions which our members had. You took us through the different series of funds, different instruments, and you took us through the CPS for startups. And also you gave us the special right in some terms of liquidation, again, where our members were gaga about it. They wanted to know more about it, and they actually wanted more sessions about it. And we are also now clear on various series of investments and how the liquidity and preferences work. You gave us a good time to give us clarity on these questions. And also you took us through how the employees will be at loss if you are not actually following a good, this one by using, I think, a good day case study you gave us. You also brought in the practicals in terms of Snapdeal and Flipkart deal in context of this particular valuation. And as you saw, our members were not willing to let go of the questions. They wanted more deliberations, had more questions unanswered, which you actually took at the end after completing all your liquidation preferences things. And also, you rushed through us through the various different approaches of valuation for different instruments. I know you had given us time up to 10 o'clock, but you didn't show any hurry in completing the session even up to 10:30. We from Bangalore Valuers Association for all your time and efforts and for giving such a wonderful presentation. And we would like to hear more from you. And I request Shilpa, as many of them have requested, to hear more from Atulji. So with this, I'll give back to you, Shilpa. Thank you.
Friends, 28th February is the last date, for the discount for renewing of membership. Kindly renew your membership if you have not already done, to enable the special offer which we are giving to all the valuers. Thanks all for your patient hearing and making this a wonderful interactive session. We are very humbled to have Mr. Atul enlightening us on this subject. Thanks all. Have a happy weekend.
Shilpaji,
Yes.
can you share the PPT of today's session, please?
Yes. Speaker will be forwarding to me, and I'll be forwarding to all of you.
Okay, fine. Thank you, Shilpaji. Very nice. Thanks for running very nice session, Shilpaji.
Thanks everyone. Thanks. It was my pleasure actually to present that, and hope it'll be fruitful to everyone. Thank you.
Thank you.
And just want to add thank you to BVR team. So to bring one of the best mind in complex security valuation. So kudos to Atul for his wonderful effort, and thank you so much for Atul. It's wonderful to hear you.
Thanks, Ramesh. Thanks, everyone.
Thank you.
Thank you.